Okay, good morning. So we can start. Sorry for the slight delay, but we wanted to make sure that we also had the hybrid part of the event working properly, and now we are all set. So good morning and welcome to you all. Some of us are here, some of us are connected. So today is therefore a hybrid conference on the title Climate Finance in a World of Fundamental Uncertainty, the Challenge for Central Banking and Financial Regulation. And my name is Elena Carletti. I'm the Dean for Research here at Bocconi University and Professor of Finance in the Finance Department. I think the title of the event really says it all. Probably we don't need to spend a lot of time explaining what this event will be about. But let me just say, we live in a world of real fundamental uncertainty for what concerns climate and how the climate will develop. And in this situation, we are seeing that all agents involved, politicians, public authorities, private sectors, regulators, are trying to sort of navigate in this environment. On the one hand, they're trying to set the policies, coordinate, having actions. On the other hand, and especially the private sector, trying to anticipate what the authorities will be doing and trying to adjust to what may come in the future. So this is clearly very complicated because, as we know, information and in particular data are still very limited. So it's a sector where, and we have experts here of data and everything, where really taking action and understanding what to do is extremely complicated. So today's event will tackle precisely these questions. How are central banks and financial regulators, for what concern monetary policy, financial stability, and financial regulation, thinking about what to do in the climate sphere, and how they are preparing for doing what they plan to do? So I'm really happy to have contributed to organize this event and have the possibility of introducing it. This event is a joint event, Bocconi University and SUERF, the European Money and Finance Forum. Within Bocconi, the core centers that organize jointly this event are, on the one hand, the Buffy Center for Economics, Finance and Regulation. This is a very old center of Bocconi that is growing and growing, and the director is Professor Donato Masciandaro, who is here, who also happens to be the SUERF honorary treasurer. So we have a special link also through Donato. And the second institute is instead a very new institute called IEP at BU, which stands for Institute for European Policymaker at Bocconi University. It's a center that was born last year, is 1 year old, more or less, almost 1 year, is directed by Daniel Gross, who is German, but actually is more Italian than many of us, I would say. And is a center that Bocconi started in honor of Mario Monti, Professor Mario Monti, and his contribution to Europe when he retired as a president of this university. So as a Dean for Research, I supervise all research centers of Bocconi. So I'm very happy to actually see these two entities organize something together. And I'm also actively participating in them as a director of the unit Banking, Finance and Regulation in Buffy and as a member of the Management Council at IEP. So very pleased to see this collaboration between two centers of Bocconi that are very transversal on the topics we will be doing today. And very happy that also this collaboration is with the SUERF, of which I also have the honor of being a fellow. So this is really like a combination of all my activity, of some of my activities. Of course, organization and centers have people behind. So let me mention and thank the organizers of this event. One is Valentina Bosetti, professor for environment and climate change in the economics department at Bocconi, and also a member of the IEP Management Council. Then Ernest Egnan, the SUERF Secretary General, very active. For those of you who receive thousands of emails from SUERF with all sorts of activities, research products, and so and policy work. So very well known in the central bank community. Irene Monasterolo, who is just become Professor of Climate Finance at Utrecht University, and is also a fellow of SUERF. And of course, so thank all of them for having co-organized this event. And of course, behind an organization and scientific coordinator, there are always the logistic. So the three people that have made this possible are from Bocconi, Elena Suragni, and Silvia Tesauro, the administrative coordinators of Buffy and SUERF, and the IEP, respectively. And from the SUERF side, Dragana Popovic instead, who also is here, and she is, I told her she's the executive secretary. She said, no, I am the head of organization. Whatever you are, you made this possible as well. So thank all the three of them for making this possible. So last word, how this event is organized. We have a morning session and an afternoon session. In the morning session, we have more the academic part. We start with the keynote by Nicola Ranger in a minute. And then we will have 3 more academic papers. Unfortunately, one of the speakers is sick and couldn't be with us. So Andrea Polo will be connected with us online. And then in the afternoon, we will have another keynote speech by Irene, and then we will have instead a policy panel with Lucia Alessi, Chris Faint, Benoit Moujon, and Livio Stracca. So let me thank all the speakers, those that are here and the 2 that are connected online, for making it to Milano, despite the weather forecast and other impediments that are typical in January. So I really look forward to this event and to listening and discuss with you all this topic. So let me now turn to the morning session and let me welcome our speaker, Nicola Ranger. She is from University of Oxford, where she leads the Resilience and International Development Program of Environmental Change Institute. She's also the executive director of the Oxford Martin Program on Systemic Resilience and the senior research fellow at the Institute for New Economic Thinking of the Oxford Martin School. She does a lot of things in terms of climate. She is senior advisor and advisor to many organizations, including the World Bank, the European Commissions, and the like. I don't think I have the time to mention all these positions that you hold. But let me just say that we are very grateful that you came to Milan and you are here with us today. And your talk is really starting the staging is managing climate financial risks in a complex world, implications for central bank and supervisors. Thank you again. And we have an hour and people online can post questions in the chat.
Thank you so much, Elena. It's a real pleasure to be here. So let me thank the program committee for the invitation. It's a real honor to be able to give this introductory keynote. So as was used, my name is Nicola Ranger. I'm based at the University of Oxford, and I lead a program there around sort of systemic resilience. So we look particularly at both climate, but also nature, and how to strengthen the resilience of our global economy and global financial system, and also the intersection between those. I should make a confession at the beginning, which is that I'm not a financial economist, but I have many friends here who can delve into the more technical questions if need be. But where I'm going to focus today, and I'll start the introduction in a moment, is really sort of going from the science to the finance. So what is the nature of the uncertainty that we're dealing with? How are central banks and financial institutions actually managing these risks or not managing them today? And what do we know about the sort of techniques and methodologies and data that we need to better manage these risks in the future? So I always sort of start with where we actually are in terms of climate change. So as I'm sure you will all know, last year was by far the warmest year on record. So this shows the historical temperatures up to 2023. So last year was an El Nino year, which we expect it to be warmer than normal as an El Nino year. El Ninos happen about every 4 years globally, but this was unprecedented and well above what anyone would have predicted would have happened for this level of warming globally that we're seeing. So this year, actually, as you all know, globally, we're aiming for a target of keeping temperatures below 1.5 degrees. Last year, temperatures topped 2 degrees above pre-industrial levels. Now that will go back down again because this is a natural variability, but shows how very close we are to the line at the moment and how much warming has already happened. And I think when we sort of hear these sort of numbers, 1.5 degrees, it doesn't sound like a lot, but actually that is a significant, that's greater level of warming than the world has seen for many hundreds of thousands of years. So we are very much in a new regime already. And I have here the famous, in my country at least, a statement by our central bank governor at the time, Mark Carney, who really sort of set the stage in the UK and beyond of being one of the first sort of central bank governors to really take to sort of say why he thought it was significant as an issue for the UK climate change. And actually before this, our previous central bank governor had always sort of maintained, you know, climate change is a problem for government. It's not a problem for central banks to worry about. And Mark Carney was the first in the UK that gave a big speech back in 2015 that identified why this was a critical issue for central banks. So, you know, making the point, this is one of his famous statements, once climate becomes a defining issue for financial stability, it will already be too late. So there is this link to financial stability, and we need to act on that now because we are locking in future risk. And this sort of started a huge amount of work on disclosure frameworks to actually make those risks more apparent. So where are we now then looking forward? So this screen is quite bright, isn't it? So this sort of shows where we are in terms of achieving that 1.5 degree goal after COP28. So COP28 were the climate negotiations that we just saw in Dubai. So you know, prior to COP28, we were heading, if you look at sort of current policies that are in place, we were heading for around about 2.7 degrees, depending on how you count. If you're really optimistic, maybe about 1.8 degrees. And this analysis here by Climate Action Tracker, so Climate Action Tracker every year sort of does an analysis of all of the global policies and what that means in terms of where we are in our global goal. And they looked at the outcomes of all of the new announcements that were made at COP28. And this is the line where we need to get to in our emissions to actually meet the 1.5 degree goal. The line up there between 48 and 52 is sort of where we are on current policies that were made prior to COP28. And you can see the little arrows moved a bit after COP28, in particular the commitments that were made around renewable energy and efficiency pledges. But still, you know, if you add up all of these, we're still a long way from where we need to be in terms of meeting that goal. But we are making steady progress. And certainly one of the, I think for me anyway, most brilliant news articles that came out last year in the UK. So as you might have seen in the UK, we've had some interesting times on climate policy recently. And there was the big speech by our Prime Minister, Rishi Sunak, around September that laid out various new climate policies in the UK that are actually perceived and analysed to be quite a backtracking of what the previous government had said. And quite beautifully, a couple of days later, this article came out in The Guardian from Sam Woods, head of the bank's financial stability watchdog, saying, we need to start thinking about bigger climate scenarios. So really pointing to the need for banks not just to be focused on transition risks, which is what they were focused on before, banks and other financial institutions, but to really start thinking about physical climate risks, given where we are in terms of the policies. So this is the sort of landscape that I wanted to lay out. And what I'll talk about based on the research that we've been doing. First, you know, some introduction for those of you that may not be in this space on a day-to-day basis. I'll talk about some work that we did on learning from the CBES in the UK. So the CBES was the first climate stress test that the Bank of England did in the UK, and we worked with something called the Climate Financial Risk Forum, which is a forum convened in the UK by the Bank of England of financial institutions. So we did some work with them to look at what were the outcomes of that stress test. Did it meet what the Bank of England wanted? And then from there, I'll come more into looking at research around what these uncertainties are, particularly looking at acute risk. So acute risk, we mean sort of extreme weather events, looking at cascading risks. And I'll particularly talk about some new work that we've done on the interplay with nature-related risks, and then also on compounding risks as well, and then end with some implications for central banks. So these are the sort of academic and other research works that I'll be drawing from that I've been involved in over the last couple of years, working with many wonderful colleagues here as well, both some more on the sort of science side, some more on the finance side, So myself, I'm a modeler, so quantitative modeler, but particularly in the last couple of years, I've been involved in a lot of working with financial institutions to see how they are managing these risks, and doing a lot of more sort of social science research in that area as well. So to provide a brief introduction then, so I'm assuming that everyone has experience in this area, so I won't go into a huge amount of detail, but basically, you know, in terms of climate change, we talk about transition risks and we talk about physical risks. Transition risks being those risks associated with the transition towards a low carbon economy or a nature positive economy. So risks around sort of changes in market expectations, pricing on carbon, etc. I'm going to talk here more about the physical risk side, which is more my area of research. So these are risks related to increases in extreme weather events, changes in agricultural yields around the world, so impacts on supply chains related to physical climate risks, and how those flow. My research is around then how do those flow into the financial system, and how can we actually model those risks given the constraints in a lot of the models that we're working with at the moment. And this is the sort of IPCC perspective on future climate risks. So when, as a researcher in this area, I always start with the IPCC, the Intergovernmental Panel on Climate Change, which is our synthesis of the scientific knowledge. And one point I wanted to make in this is to help you understand what are the sources of these risks, and what does the IPCC, so the scientific community, say are the things we need to really worry about. So this is quite a famous, horrendously complicated diagram if you haven't seen it before, but it's quite a sort of famous diagram called the burning embers diagram. So these burning embers, and what these basically show is different dimensions of risk. So unique and threatened systems, this is basically ecosystems, extreme weather, distribution of impacts, global GDP impacts, and then these are the sort of big discontinuities, big tipping points type impacts. And what it shows as we get redder is the growing risk. And these are the temperature projections based on models of different scenarios. So this is around the 1.5, and you can see at 1.5, we already have quite big risks to threatened systems, big risks related to extreme weather events, but it's really as you get to the higher temperatures that you start getting the big risks associated with tipping points. And these, if you read through the report, and I've pulled out a statement here, these big tipping point risks and the big extreme weather event risks are the ones that scientists really worry about in terms of how that will then feed into economic and financial risks. So the sort of chronic risks to some extent, so these are the risks that change gradually over time, you know, there's good potential to adapt to those risks, particularly in high income countries, but these shocks and these tipping points are ones to be very worried about, according to the science. I think that one key takeaway from this, as sort of financial experts yourselves, is that when you look at the models, the economic models and the financial models, these are the risks that are missing. So if you look at the economic and financial models, they particularly look at the chronic risks, so the gradual changes in risks, and they're just starting to think about extreme weather events, but they totally miss anything to do with tipping points, the big risks at the moment. And so actually we have this disconnect at the moment between the science and the finance, which as a researcher is really interesting. But you know, for governments and financial institutions that need to be managing these risks, and central banks that need to be thinking about these big risks, actually we don't really have the tools at the moment to do that. And this is a huge research effort at the moment to try to better capture what we know from the science in the economic and financial models. And that's why people like me that come from a scientific background work with people like yourselves. So why is this important? Why? Because obviously, you know, we do focus a lot on the transition risk side, and but these physical risks are absolutely critical to think about as well. And what we know, and this isn't from my own research, lots of research in this area, is that these physical climate risks are systematically underpriced across financial markets at the moment. So you see in some areas, you're starting to begin to see them being priced in. So let's take, you know, areas of the US that are very exposed to extreme weather. There's evidence that they're beginning to be priced in, but actually, you know, even in those cases, these risks are not being priced in. And that creates problems both in terms of financial resilience, but it actually also creates problems in terms of our ability as a world to adapt to these risks. Because what we're seeing at the moment is that financial decisions are being made every day, which are not pricing these risks appropriately. And that means that there's an insufficient incentive for firms to then be adapting to these risks. Yeah. I'm happy to, yeah.
So, but you need a microphone. Where is the microphone?
I wonder to what extent this, going back to your previous slide, no, the one before, so the ones which are RFC5, isn't it also because the likelihood of these events is, say, growing expansionally with the temperature, and you need to be so they will materialize at an horizon which is way after the maturity of most financial assets. And isn't it the reason why? So we need to get ready at some point in the future, but they would not be relevant currently for a wide variety of assets.
So to some extent, yes, but not totally. And I'll talk more later on some research that we've done on this topic. So yes, hopefully the big global tipping points that you often hear about, you know, shutdown of the thermohaline circulation, loss of ice sheets, hopefully those are a few decades away. But what we can see from the evidence is that actually locally, you can see tipping points that come much closer in time, particularly when you start looking at the interaction between climate change and the natural world and ecosystems and these complex feedbacks. And I'll show you a lot of historical analogs that show these types of risks. But you're right. But actually the big one that worries me and where I do a lot of research is the extreme weather events. And I'll show some analysis on that. And a lot of the models don't fully capture those types of risks at the moment. So I was just sort of going to say what another reason, I know here we're talking about financial stability, but why for the real economy, this is really important as well. Because what you see, so in the climate negotiations, we focus on, we need to mobilize another 100 million for adaptation, for example, these sorts of numbers. But actually what we need to do globally, if we look at something like infrastructure investment, 2.7 trillion around the world is going into infrastructure investment every year. A lot of that investment is not considering these risks. So we're structurally locking in these risks. Now, there's only so much we can do through the financial sector and through thinking about things like disclosure frameworks, etc. That's an important part of it. Part of it needs to be other areas of policy as well. But the fact that we're not pricing these risks is, I think, it's one of the building blocks that we need to managing this accumulation of risk that we're seeing in the system at the moment. So now coming to how do we think about scenarios at the moment? So obviously, one of the key outcomes of what I've shown here is that when you're thinking about stress tests, you need to be forward-looking, because history is not going to tell you anything about the future. So if you're doing a stress test and you're only looking at historical volatilities, you're missing a lot of the potential risks. So we need to shift from this backward-looking to a forward-looking approach. And to do that, it means we need to get more comfortable about thinking about scenarios. And it means also that we need to get more comfortable in how we bring together both the science and the finance to develop scenarios that are relevant for financial decision-making. And this is a big new area. You know, the NGFS has obviously really spearheaded this globally. And I think we're now on our third iteration of scenarios. And we've seen huge momentum and innovation in this area of trying to bring together science and finance to develop these decision-relevant scenarios. So this sort of shows the basic NGFS framework. This is actually the one from 2021. And this approach to developing scenarios on physical risks which couple together basically integrated assessment models. So it's based on an integrated assessment modeling framework with some sort of other pieces around the outside as well to try to capture some of these acute risks. But what we know is that a lot of the scenarios that we have at the moment, and again, noting that we're only a couple of years into doing this and we're innovating very quickly, but still those scenarios that we have at the moment do not capture on the physical risk side all of the key sources of risk. And I'll show you some work that we've done with financial institutions on this. So this is actually a diagram that I actually produced about 20 years ago on integrated assessment models when I worked for Treasury in the UK, looking at to what extent integrated assessment models pick up the bigger risks to do with climate change. And actually, while they've improved over time, they're still not capturing. So a lot of them are focusing on chronic risks, maybe just beginning to capture some of the extreme weather risks. But in terms of how they're capturing those and how they're capturing the uncertainties in those, it's still quite limited. So this sort of shows how uncertainties are being captured. And for example, a lot of the scenarios at the moment focus on the emissions uncertainty, but not the climate uncertainty. And climate uncertainty is very large. So we don't know for a particular emissions scenario, or we know for an emissions scenario that there'll be quite a wide range of possible outcomes of climate and impacts. And we're not really fully looking at that range at the moment. So there's a lot of uncertainty. And here we're talking about uncertainty data that's not being captured at the moment and could leave us underprepared. And one of the particular areas that I've been focused on is these complex shocks, complex cascading risks. And I think many of us got very interested in this area after COVID, because COVID really showed us that we can't just think about one type of risk in isolation, that actually in practice, different types of shocks compound together. They are communicated globally through supply chain networks, through our global financial system. And if we're not taking into account these cascading risks and the network effects associated with this, then we're significantly underestimating the risks. And some areas that I particularly work on are around infrastructure systems risks that we do a lot of modeling on in Oxford, and also sort of trade flow risks, and particularly areas around the food system as well. And one very scary statistic, which actually comes from McKinsey, and I don't usually like to quote McKinsey, but this was a particularly good study on a multiple breadbasket failure scenario. And they pointed out that most of our food comes from about 5 global breadbaskets, 5 countries in the world. So most of our calories from sort of cereal crops come from these. And actually the probability that each of these is affected by a big drought at the same time is a lot more than I would be comfortable with. So what we found is that what was historically about a 1 in 100 year event for these 5 breadbaskets to be affected at the same time is potentially doubling every decade now because of climate change. So there are big systemic risks that we're not thinking about at the moment in our financial analyses. So this sort of modeling is the sort of modeling that I do. So the key messages then here are, if our assessment of these physical risks comes with significant uncertainties, we know they are large, we know they are material, and these risks are underpriced at the moment, is what the research says. Scenario analysis is advancing incredibly rapidly, but actually is still in its infancy. There's a lot of evidence that positive things are happening in the market, and I'll talk more about that. But really, I think we need to get much better at looking at how do we bring in this wider range of evidence into financial decision-making. So let me then just talk about some of the research that we've done in this area. So as I mentioned, we worked last year with the Climate Financial Risk Forum in the UK to see what the impact was of the UK's first climate stress test. So in the UK, the largest banks and insurers were asked to run a set of scenarios and report back to the Bank of England. We, through a process of just over a year, surveyed those financial institutions, ran workshops with them, worked with a team of social scientists to do this. We covered both the insurance and the banks. And what did we find? So our finding number one, and I should say that this exercise had a number of objectives, and I know Chris Faint will speak later, so you can ask Chris Faint about this as well. But it has a number of objectives. So it was really about capacity building. So the aim of this first scenario exercise was really to get the financial institutions to start trying to run these scenarios. The next objective was around trying to encourage the banks and insurers to start building these scenarios into their decision making in their financial institutions. And the third was to get some sort of estimate of what was the scale of the financial risk to the UK. And the findings were that actually this exercise, which ran for just over a year, the banks in total had to do this, and insurers, led to significant improvements in the capacity based on their own reporting. So what we saw is they built up huge teams, they innovated in the methodologies they were using. They, as part of this, are around, so all of them sort of reported on this big improvement in capacity. It didn't really affect their core processes. So you can see only about 20% of them said that this led to climate becoming an integrated part of their business strategy. But it was an important start. And 60% of those we interviewed said that they strongly agreed that it had been beneficial. And it was quite interesting because talking to them, this exercise was a big thing. So it took, weeks, months of huge teams' time to do. And it actually happened just after COVID and as we were going into the Ukraine crisis as well. So these financial institutions, their risk management functions were already extremely busy. And then on top of that, they had to do this. So we heard a lot of negative feedback as well about, why had the Bank of England decided to do this at a time when we were dealing with COVID and the Ukraine crisis. But actually, even with that stress that it put on the system, they did agree that it was a very positive exercise. We asked them a lot about what challenges they came across. And actually, the biggest challenge that they came across in doing this was the modelling of physical climate risks. So they felt pretty comfortable about the transition risk side. There were some issues there as well, particularly in data from counterparties that they could get, particularly sort of transition plans, counterparty level data. But it was the modelling of physical climate risks that they technically struggled with the most. And what we wanted to know from them is, did they feel that the scenarios that they were given actually captured the risks that they were really worried about? So the scenarios that they were given were based on an earlier generation of the NGFS scenarios, which were sort of tailored to the UK context by the Bank of England. And we wanted to know, how comfortable were they with those scenarios? And what we found was that on the transition risk side, about 65% of them felt that these scenarios adequately represented the range of material risks. But on the physical side, we found that only about 51% agreed that they adequately represented the range, and about 43% believed that they were far too narrow. And actually, if you looked out in time, so looked slightly longer term, they felt that there were significant sources of material financial risk that were not being captured by the scenarios at the moment. So that sort of shows, again, this disconnect. And we asked them about what did they feel that were missing. They were very worried about, on the transition side, rapid shifts in policy. So things like actually in some countries that we've seen, so when governments are putting in net zero policies, but then perhaps retracting those or weakening those over time, that creates an enormous amount of policy uncertainty, which was a big concern to them. They were very worried about supply side shocks, both on the transition and the physical side. They were worried about big geopolitical shocks related to climate change. They were worried about supply chain issues. So there are a lot of sort of these more sort of complex and cascading risks that they were worried about. And the recommendations that came out of this, there was a big report of recommendations, but the key thing that the financial institutions wanted to see was more collaboration to develop improved scenarios. So they wanted to have fora where they could actually work together to explore this in a sort of pre-competitive way, I guess, and actually have fora to work more with a wider range of scientists and economists as well. They had big asks on data, so asked for the government to invest more in open data in this area, as that was a key pain point for them. And they wanted more sort of peer review of these scenarios as well, because they felt that they'd been given these scenarios, but without, really having that expert input into them. So now I'll talk about what we actually know about these acute cascading and compounding risks. So I said, so the previous analysis shows that we know from the science side that these are missing from scenarios. We know that the financial institutions themselves are saying these are missing. They're recognizing that, and they're asking for more information. So what do we know then from the evidence in this? And so a lot of my work over the years has been around this. How do you manage uncertainties in climate? And I've worked on this area for a very long time in a whole range of areas. So, at Treasury, looking at economic impacts to the UK, but also things like planning how to design the Thames Barrier in the UK. And I think the key thing about climate risk is we are dealing with a situation of deep uncertainty. So we're dealing with a situation where we can't put probabilities on different future outcomes. And that shifts us into a different paradigm then of how you manage these deeply uncertain risks. So I'll show you a few sort of studies that we've done over the years in these areas. So one thing that we've played with a lot is how can we take all of the learning from the insurance industry and bring that into the banking sector to help them estimate these risks? So the insurance industry is used to dealing with physical climate risks. They do it all the time, arguably on short timescales. So one of the things we've done with the IMF and the World Bank is work with them on looking at taking insurance models and linking them together with banking sector stress testing frameworks. And we did this for the Philippines FSAP a couple of years ago, actually sort of linking this science into the economics and then into the finance. So starting with climate models, then running insurance catastrophe risk models, putting those into macroeconomic models, and then finally the IMF running a sort of standard bank stress test based on that. And what did we find? So for the Philippines, this shows different return periods of events. So we looked at typhoon in particular, different return periods. So this is basically represents the annual probability of events and the value of losses and the impacts on bank capital as a result. And in summary, what we found is that actually for the Philippines, it was quite resilient to up to around a sort of 1 in 100 year event coming into the Philippines. But it's actually the big rare events that were problematic for them. And the really interesting conclusion was that where there was a really potentially big problem was when a typhoon hit at the same time that the economy was already under stress. So a compounding event. So what we did is we looked at scenarios that represented, for example, the Asian financial crisis and said, well, how would the Philippines cope if it was in that sort of situation and then hit by a typhoon? And it was those sorts of compounding risk is where we found particular sensitivities of the banking sector. And then that led on to a huge range of new research with my good friends here, and particularly Irene Monestarolo, over a number of years, looking at what is the economics of compounding risks. Because at the time, and this was during COVID that we were doing this analysis, there was very, very little analysis of how climate risks and non-climate risks would come together and interact. We didn't know, would they amplify each other? Would they dampen each other in some way? So actually with Irene Monestarolo, we worked as part of a big team looking at coupling climate scenarios into macroeconomic models and looking at what are the risk transmission channels and how would they combine when a physical climate shock happened at the same time as an economic shock of some kind. And this basically shows the results. So we looked at a compound risk factor. So this basically said, if two events happen at the same time, is the overall impact larger than the sum of the parts? basically. So what you can see is if the number here is 100, it means that it's either the impact of both shocks happening at the same time is just the addition of those shocks. If it's more than 100, it means you're getting an amplifying factor. And we looked at here, we actually worked in a number of countries, but this is actually showing the Philippines and Indonesia. And what you can see based on the modeling that we did is that you get quite a significant amplifying impact. So up to around sort of 30% over a couple of quarters. So you can see then if we're not including these effects, then we are significantly underestimating the risks. And I'll speed up a little bit so we have time for questions. We did a report this year actually with the NGFS, led by the NGFS, we fed into it, looking at how central banks themselves were thinking about these compounding risks. So again, this was more of a sort of interviewing, analysing the literature type study. And we asked NGFS members what they thought of compounding risks. Was it something they're worried about? How are they managing them now? What we found is that of the 26 central banks that responded to the survey, and these were globally spread, all but one of the respondents agreed that it is important to consider these compounding risks as part of climate financial risk assessment. About a third strongly agreed. But interestingly, we found that only a quarter of the respondents had actually started to incorporate these compounding risks in their climate scenarios, although around 60% did include compounding risks within normal stress testing, non-climate stress testing. So you'll often see within non-climate stress testing, we'll always be thinking about, what happens if an inflation shock comes at the same time as a different type of shock. But actually, this isn't in climate stress tests. So there seems like quite an easy win there in terms of, combining the lessons from these two areas. So I want to just sort of wrap up and talk a little bit about nature. I know this is an event about climate, but we can't separate climate and nature. What you see is that the erosion that we're seeing in natural capital around the world is again significantly amplifying the impacts of climate change and vice versa. So this is a report actually we did in collaboration with the NGFS task force on nature, looking at how would we bring nature into our climate stress testing frameworks? Can we do that? Do we need a different approach if we're bringing in nature? Just to sort of update you on some of the science in this area, and I should say before about 18 months ago, I didn't work on nature. I was a pure climate person. So we've been working very much with ecologists to do this work, and that I'll show you here. The equivalent of the IPCC in the nature community is something called IPBES. So this is the Intergovernmental Science Policy Platform on Biodiversity and Ecosystem Services. And like the IPCC, they review all of the scientific and economic evidence and provide a regular update. And they've found that 14 of the 18 critical ecosystem services have declined since the 1970s. This is showing those. So when we talk about nature, I'm not talking here about birds and butterflies. Obviously, I care personally about birds and butterflies, but I really care about those critical ecosystem services that our economies cannot function without, which includes things like processes that lead to clean water, clean air, food. And those are being eroded. I'm sure most of you have probably seen these diagrams, which is this sort of famous work by the Stockholm Resilience Centre on planetary boundaries, showing how our different planetary boundaries are being crossed, up to now the most recent assessment that came out a couple of months ago, showing that 6 of our 9 critical planetary boundaries are being crossed. Now, we often talk about this separately from climate change, but these things are fully interlinked. I did promise to talk about historical analogues a little bit. So as part of this work for the NGFS, we did some work looking back in time and looking at some historical crises that had a climate and nature component to them. And these are not crises that are, back in thousands of years ago. These are all things that have happened in the last 100 years, and also to high-income countries. And what you can see is quite a significant risk of quite localized tipping points in particular countries. So issues around dust storms, for example, in the Middle East, issues around sort of oral sea crisis, salination crises. And what you can see when you look at these crises is that it's always climate and nature happening at the same time. And it's always a social and political response aspect as well that is creating these crises. So again, when we're looking at risk, we can't just think about climate in isolation. We need to think about that complex interplay with society, with policy, and that can lead these to turn into major crises. And we worked very rapidly last year to put together one of the first globally consistent risk assessments of these risks, which combined a sort of an input-output modeling approach with a lot of ecological modeling to produce this global analysis looking at 5 different major ecosystem services around water, pollination, air quality, water quality, to look at what the scale of these potential risks were. I won't go through them in a lot of detail, but the sort of headline numbers that come out of it. And again, I would say that this work is pretty sort of preliminary, but the numbers that come out of it are very large. So risks related to water, again, our scenarios at the moment on climate don't actually include much on water, surprisingly. But we could be looking globally at sort of value at risk in the sort of 5 to 7 trillion globally. So these are very large numbers. Pollination risks in sort of hundreds of millions, water quality risks over 1 trillion. So very, very significant risks, which again are missing from a lot of the analyses that we're doing at the moment. So what are the implications then? So what we can see is there are significant gaps. We're making good progress, but there are significant gaps in the way that physical risks are represented. We're underestimating, therefore, the potential scale of these risks to the financial system, and that's recognized both by financial institutions and also many central banks that we've interviewed as part of the paper that I mentioned. And there's a very strong call from financial institutions for more collaboration in this area, for more transparency and openness over the gaps and the assumptions in current scenarios, and a desire for more collaboration to develop the next generation of scenarios. But one of the things we're often asked, and maybe we can come to this in the discussion, is, but are these risks actually different to risks that financial institutions worry about all the time? You know, if you look at normal financial risks, they are always deeply uncertain. We never know what's going to happen in the next year or so. We never know which other crisis is coming down the line. So what is unique about these climate risks or nature risks that mean that we need a different approach? And we've talked about the forward-looking approach. I don't think anyone would argue about that. But does it mean a fundamentally different approach to prudential policy because of the nature of the risk? And I think certainly you can see that there are differences in these risks versus other types of risks. So the fact that the past is not a good guide to the future. These are structural changes in our economy. They're not marginal changes. The transmission channels of these risks are fundamentally different to the types of economic shocks that financial institutions are used to dealing with. And there are these potential for systemic impacts. So whole supply chains being affected, whole regions being affected at the same time. So I think the question it sort of leaves us with is, you know, how do we manage this? Does it require a different approach to prudential policy, for example, as a result of this? And maybe we can leave that open to discussion, and I'll finish there.
Thank you, Nicola. This was a super interesting speech and a fantastic start of this event, I think. So let me collect the questions and then I can ask. I don't know if there are any questions in the audience. Livio, and then there is a question in the chat, but let's start, and then I also want to ask you some.
Thank you. So I thought indeed it was a fascinating talk. So on this in this area of physical risk, what I don't fully understand is why there is. I mean, on the one hand, we always say, you know, climate change now is here, and so the disasters associated with climate change we should be already observing, and in fact we have been observing them. So we have droughts, we have floods, and so on. So how? But on the other hand, I personally don't know of any financial institution who was in any type of trouble following in any of these events. So what do we learn from that? So, you know, is it possible that that these institutions are diversified enough that they don't rely on a specific area of firm. Can we learn more from success, and not only from failure, but also from success? So why are these banks so resilient on this? And also, in this literature, a lot of people use scenarios and so on, but I don't know why there is no more actually exposed evidence on losses. So, I mean, the nice thing for economies of climate events is that they are exogenous. So it should be easy to see, based on diff or something, which banks are not exposed and so on. But I haven't seen a lot of research on those type of more exposed analysis. So I wonder what's your view on that.
Do you have a question? So can we give the microphone here?
Yes.
Let's collect this.
One question which is related to this question. That's a good news that banks seems to be resilient, but do you have any simulation on how many banks are able to address this kind of risk? Because it seems to me, as just a feeling, is that you have to invest a lot in the present and is likely in the futures. So in this sense, which kind of banks? All the banks, just the big bank, just the international banks and or is insurance? Thanks and congrats for your presentation.
Benoit? Oh, wow. We have a lot of questions. Okay, please. Okay, last one, and then she replies, otherwise she rightly say, let's take 3 at a time, please.
No, and thank you for your intervention. This is a question maybe for the whole event speakers and public, because I'm from the market, I'm not from academia, I'm working for an asset management company, and this is a time for outlook for this year, and I don't see anybody pricing or thinking about these risks in the financial outlook for this year. Or I've been following the global risk report from the World Economic Forum last week were presented, and also they talk about not only climate risk but also AI risk, risk related to AI for election this year. And still, I don't see anything in the market outlook for this year and for the years to come from the market where I'm from, because everybody is very positive for this year and etc. So the question is the market talking with you? Are you spreading and trying to make this risk is not an accusation, it's just a consideration, general consideration, because I'm feeling quite overwhelmed of this, because I'm in a market that doesn't care about that, seems. And when I'm coming to these events, instead, I feel the pressure and the urgency of action, not only for the market, but also from the politicians. And this year there are lots of the election, and I don't see many politicians talking about them. So this is more a consideration than a question, but it's for everybody. And contribution to this discussion. Thank you.
Now let's give a chance to reply, and then but you have your microphone. So
Yeah. Yes. Yeah. All very good questions, and thank you so much for the question. So the first question was, so are banks resilient now, and why are they resilient? So when I started out on this journey, we did do a lot of looking at the literature on to what extent banks currently are resilient to these risks. And there is within the literature, and that literature has grown since I did that literature review a couple of years ago. There are a lot of examples of banks under stress because of these risks, but they tend to be quite localized, so and more in actually not even so much more developing countries, but tends to be particular types of banks maybe that are not part of a sort of more complex financial networks that are having to absorb more of that risk themselves that are being affected. So there's studies in the southern US, for example, in the Caribbean, that have shown that. when we've looked, when, you know, my former role at the World Bank, sort of advising central banks, you know, what you can often see is obviously banks, the central bank isn't sitting idle when these events are happening, they're acting. So there'll be changing provisioning requirements. There'll be, in some cases, there's sort of partial credit guarantee schemes that are being used for banks. So there are interventions. And actually, so it's actually very difficult to tell what would have happened in absence of those interventions. And I think the important question is, to what extent can those interventions, will they remain resilient in the future when we see more of these types of events and more systemic level events? So I think that's an open question. And so one of the only study that I can sort of draw on that is actually one that Irena and I worked on, and I think maybe Stefano, some of your work as well, that looks at how banks are responding, particularly when there's some sort of capital constraint on them already, or when those types of policies are not being put in place. And you can see that the impact on the banking sector is much greater, dependent on the policies that central banks are using. And I think the other interesting piece, which I didn't talk about here, is the link between the fiscal and the financial sector. Because particularly in developing countries, what you can see is often the government is in some way absorbing some of that risk currently, particularly for developing economies. And so if the government is under stress, you know, for a whole variety of reasons, it means the banking sector is going to have to absorb more of that risk. And you can see, again, based on modeling that we've done in the past, that in that situation, the banking sector is more impacted. I think insurance is really important to think about as well. So at the moment, in many, say, high-income countries, the insurance sector is absorbing a good part of the risk. So again, a lot of discussions that we've had with regulators are starting to get quite worried about what happens if the insurance sector is under stress and is not able to absorb that risk, or the insurance is being pulled out of these markets, and then more risk will come onto the banking sector. But you're right that at the moment, and this is sort of one of the challenges that we often hear in this space. You know, we coped with COVID. We don't need to worry about climate change. But actually, there were a lot of interventions that were put in place to cope with COVID, and whether we could do that every year, I think, is very uncertain. I think maybe that partially answers your question as well. I think the question about investment is an important one. So the adaptation investments, because obviously I'm all just talking about risk here, but when talking to financial institutions, and maybe this comes on to the final point as well, excuse me, coughing with my microphone. When talking to financial institutions, actually, they are really starting to gear up in terms of bringing more investment into adaptation and starting to see opportunities in this area, literally just in the last 6 months. There's a lot happening within the financial sector on adaptation. So to give you a couple of examples, again, we have in the CFRF in the UK, we now has its first adaptation working group, which includes asset managers as well. They're all looking at where are the opportunities, where do we need to be acting, how do we be talking to our clients about this, what kind of adaptation plans and other data should we be asking from them to better assess these risks. So there's a lot of activity in that area. And they're certainly seeing that there's an increase in public investment flows into this area, which into adaptation, which is seen as quite a big opportunity as well. But why is there insufficient urgency in action? I think maybe we can ask some of the central bankers in the room why for their perception on this. But I think, you know, I think that there's been such a big focus on the transition risk side for inevitable reasons. And I think it is only in the last year or so that there has been a much bigger focus on the physical risk side. And that particularly emerges, you know, as a result of some of the big impacts that we've seen in last year. I mean, last year I gave a presentation at the Bundesbank in a climate conference, and we were sort of stood in front of the dried out Rhine in the background. And so it was very evident why we should be starting to think about these risks. So I do see more.
Okay, let me collect some more questions. I thought there were 2 here, and then there is
Yes. morning, and thanks for the.
You can also introduce yourself if you like. I should have asked
I
also.
work for a bank, for Crédit Agricole, who cares a lot about these topics. So the question is, we talk a lot of risk within financial institutions, but banks normally give credits to consumer or to companies. So banks are asked to allocate capital according to this issue to companies that better address these issues. However, the question is, if you exclude big corporations, big companies, you have millions of small and medium enterprises that are hardly equipped to address these issues. So if banks should price or allocate capital immediately and abruptly to only to companies that are able to address the issues, we would have enormous social and economic issues. So at the end of the day, we talk a lot about banks, but we don't talk so much about users of credits and the work of banks, which are maybe more important in how you can cope with these issues. So what is your view about it?
Next.
Alessio Pezzotta from Crédit Agricole. I was a climate risk manager in another banking institute here in Italy. I found very interesting the topic about the probability that doubles each 10 years, if I correctly understood the topic. So my question is if you can add some content about this topic, and if this phenomenon of the probability that doubles is linear for all physical risks, or if there is some physical risk which is more prone to this phenomenon. And which is another question, if possible, which is your opinion about transmission channels from transition risk to physical risk, and how to value this transmission channel for banks. And thank you for your intervention.
Maybe before giving the microphone to you, let me compliment, because I also take the view of a private bank. So in my other life, I chair a risk committee of a larger bank. So I actually see and follow how the bank is taking this into account. And I was surprised by two things you said. First is this issue that banks are focusing, or that transition risk is taking much more into account than physical risk. I think this may be true for stress scenarios, but I find instead in the normal risk management activities, maybe you are right in the last year, but there is much more easiness in understanding the physical risk and calculate the physical risk in the portfolio. Because the first thing that banks can do is actually mapping their portfolio, their collaterals. So where their real estate is located, and understand, and talking with Livio yesterday, the house that is closer to the sea or not closer to the sea, in a very rudimental way, if you want. But they start already understanding, and they calculate like a high risk area and low risk area. And from that, they also trying to incorporate some of these into pricing, very little. And maybe because we are in Italy, and as the gentleman said, there is an issue of very small and medium enterprises. It's very difficult for banks to actually have data on the transition plan of these enterprises. They can do it with the large corporates. But the small and medium, and in particular the small one, is just a plethora of unknowns that is very difficult for them to incorporate, in particular with transition risk. Because clearly physical risk, they can still map the collateral side. And of course, a physical risk is not just about collateral, but of course, it's the easiest way for banks to think about it. Another thing that you said is that banks are not used to forward-looking, or at least a stress test requires forward-looking. I mean, this is true for every stress test. And I think in recent years, banks have done much more forward-looking, even in their calculations of provision, because COVID, because of the geopolitical situation, they're all things that banks did not have in their time series. So they do what is called overlays. So they calculate this generic provision. And of course, even if stress test is a bit different from provision calculation, the idea of forward-looking is more into it. But here I actually espouse what Benoit said before a little bit. If they do forward-looking, they're used to 2 years, maybe 3 years, But 30 years scenarios for them is just out of question, right? So it's very, very difficult to incorporate such a distant future into their management, more than I think the issue of forward looking itself. There is much more in recent years into their way of thinking. Let me stop here. Let me give you the microphone back, and then I go to Ernest, and then maybe. Yeah. Well, we can bite a little bit into lunch, huh? Please.
I think this would be good to have a whole discussion on this set of
Yeah.
questions, but yeah, so maybe I'll start with the Alessa's question around sort of probabilities of increasing. Yeah, so that specific result I gave was for multiple breadbasket failure scenarios. So that was looking at the probability that these 5 breadbaskets in the world could be all affected by a drought at the same time, which would have a significant impact on agricultural output and therefore food prices. So that was that for that specific case. But you do see for many extreme events, not all in this varies, but it will vary a lot between countries as well. But yes, you'll see that the probabilities are increasing. Probabilities of a severe event are increasing over time, but it won't always be a doubling. It will vary significantly by country, and there'll be a lot of uncertainty on that as well. On sort of probabilities of different transmission channels, I think, yeah, that's a tough question. So one of the things that we do a lot is trying to map those transmission channels, and analyze each of them individually and how they interact. But again, it will depend very much on different sectors, different countries, the structure of the economies, etc. And those 2 examples that I gave of Indonesia and the Philippines, you've seen they were quite different how the compounding happened, and that's because they're quite different transmission channels between countries. I couldn't talk more about that. Questions about SMEs. Yeah, so what firstly I want to say is that I've shown physical risk to be really complicated. Actually getting started is easy, and what I would not want the practitioners here to do is think that all of this is very complicated, so we can't do anything.
No.
Because
Exactly.
Because there is a huge amount. So a lot of the risks that I'm talking about here, big systemic risks, are things that central banks and supervisors need to be worrying about, and individual financial institutions as well. But these are things that I think if you're looking at macro level risks, you need to really be thinking about. But if some easy steps. So we often hear it's so hard, you can't get the data, but actually you can make really good steps by just, simple risk zoning based on openly available data. So I have a little logo here for one of my other initiatives, the Resilient Planet Data Hub, and we just make data openly available, tons of physical risk data that you can, and nature risk is on there as well. And you can make a really good start in estimating those risks. What tends to be more difficult is estimating supply chain risks. So that's a key issue, and also how the companies themselves will respond to these risks. Because actually, if you're in a high income country and you're well prepared for these risks, actually the risks may be quite low. But often financial institutions really struggle to get that data on how is the company actually adapting to this, and what measures do they put in place? Do they have good insurance? So we need much more data on those to analyze these risks, and things like, so in the UK, one of the conclusions of the Bank of England stress test was this world of uncertainty, the uncertainty about insurance in particular, and things like our public risk pools in the UK. So there was a lot of uncertainty about would our public risk pools for flood still be there in a high climate scenario, and that has a big impact on mortgages in the UK, for example. And SMEs is really such an important topic, because these types of risk assessments are very, very difficult to do by SMEs around the world, and actually they don't have access to this data, which is one of the reasons why we make publicly available data. A lot of the data that's provided by the big providers is extremely expensive, so they can't access it. And there is a big problem of finance potentially being drawn away. And banks play such an important role in the resilience of these SMEs. You can see that in the data. So I think that a lot more needs to be done by governments in helping them, one, measure and disclose risks, but also to support them in resilience. And I think maybe just a final one on the forward-looking timescales. Yeah, so we had a lot of discussion with financial institutions, particularly more large financial institutions around, yes, they're already using scenarios for other types of risks. They're already doing a lot of reverse stress testing. To what extent do these scenarios mean they need to do something different in how they're thinking at the moment? And I think there's an open question there at the moment. It's something that a lot of the larger financial institutions are really actively thinking about. Does this mean doing something different? And yeah, I think that's sort of the state of practice that I've seen, working particularly in the UK, them trying to look at sort of almost comparing the traditional sort of reverse stress testing approach with one of these scenario approaches and say, would it actually lead you to make a different decision on provisioning? And that's quite an active area of research that I don't have an answer for you. Right.
Okay, let me then finish here. Just one brief question. You can answer yes or no, and in case it's yes, we write. Is there any scientific evidence about any potential correlation between climate change and risk of earthquakes? Yes or no? And then eventually we write in the chat if it is yes.
Some,
Okay.
so in some areas, actually increased rainfall can increase risk of volcanoes, but I think it's a very marginal consideration.
Okay, so the answer is almost no. No, there is no link, basically. Okay, let me stop. Let me thank you again. And now we go to the second part.
So my approach here is to make sure that we don't eat up all the time for lunch, just a small bite. We're 10 minutes ahead, and I'll keep that in mind. So we have 3 speakers. Each of them will have half an hour, I guess, including Q&A. So I'll call you when it's the last 10 minutes so that you are reminded that if you want to receive any question, you have to stop. Net of the questions that you might receive. Is that okay, Donato, if you receive questions? Okay, so the first speaker is Donato Masciandaro, who's a professor here in the economic department. He is also the director of the Buffy Center. And of the new, in the business school, we now have a topic area on economics, is now directing that, and many other things. But I won't tell them so that he has time to tell us what he wants to present.
In terms of microphone, thank you, Silvia. Just 1 second. Sorry, I'm not familiar in this university. It's the first time that I came here. Oh, it's a nice university. Congrats. Thanks, Valentina. That's I hope that respect to Nicola presentation, if I may, I will try to go ahead, try to address with you one more perspective, in a sense, the political economy perspective in such a story. Today in this section, we have three papers, and I hope that my presentation was a complementary view respect to the other 2 papers. But given that I guess from the title that one paper is on climate change and capital requirement, the other paper is on climate change and monetary policy. But these 2 stories are 2 arms of one institution, which are the central banks. So tug of wars, which is the motivation of this metaphor. The players in the tug of wars are politicians on one side and central bankers over the others. The road is the mandate of the central bank, and the outcome of this tug of wars is actual climate change activism of different central banks. That's in a nutshell. For step motivation, which are the facts that we use as I use as starting point. Then there is analysis that we use to address and try to explain concretely the green activism of central banks, and then there are some conclusion and further steps. Motivation in recent years, both politicians and central bank seems to be sensible to climate change stories. And so the cornerstone could be the 15 years that already the speakers, Nicolas, quoted. In 2015, we have the Paris Agreement among 196 government. And in same here, there was the now famous and last quoted speech by Mike Kearney that has been already quoted. So it's the first time that there is a correlation between climate change and a central bank job, i.e. financial stability. And then there was an increasing debates, and there's been also hot debates in the sense that, you know, there are mixing reaction. I'm just quoting a couple of FT articles in which the authors wonder if are the central bank the right player that have to be involved in this kind of public policy effort. How to explain the central bank activism? Which is the economic story? Let me do just in a nutshell, which is an economic story. And from a pedagogic point of view, the more easy ways to take the, I hope, well-known model, three-equation model, in which you have a description of how the economic system works, which is a target for who? Is a target for the central banker. And then there is the reaction function of the central bank moving a tool, which is the interest rate. Please recall that this is a standard story in which we have one player, the central bank, one target, the economic system, and one tool, which is the interest rates. It's a story before 2008, the normal time story, but please recall that the central bank are trying to come back to this normal time story. One goal, one tools, one players. In this story, how to introduce climate change, you can implement two different options which are complementary. On one side, you can introduce climate change in a Hallertine-Bergen perspective. In other way, climate change, sorry for the joke, how the economic system works. And so for the central bank is a change in how the target is shaped by climate change problem. One more option, which is, as I stressed again, is not alternatives, is a Taylor perspective. In other way, you change the reaction function of the central banks. In this just economic story, there are two missing points from a political economy point of view, which are essentially two. Please, if we start from the fact, we have to recall that usually the central bank are implementing green activity, taking into account that their mandate is the same. In the sense, let me just picking up figures from the Cowan Rhodes papers, given 135 central bank, only 16 central bank had an explicit environment mandate. So for the other way, the mandate is the same. Secondly, the more the central banks are involved, become green, the more there are no neutrality consequences. No neutrality is a political consequences. And in a moment, I will try to be more clear how important is this consequences in terms of central bank action. So given these two missing points from the political economy point of view, we try to build up a framework in which we try to intertwine the two sides of the coin, the economic story and the political economic story. That's the intuition. There is a tug of war. The rope is the legal mandate of the central bank. The players are the central banks and the politician. And the outcome, in a sense, is the piece, how green is the mandate of the central bank. How are able and why, which are the motivation of this stretching of the mandates of the central bank? Some details in the story that I will try to tell you in a moment. Basically, green activists, the consequences in the central bank action is that you have to enter three different macro goals: monetary stability, financial stability, and climate change. And there are two arms in this story: monetary policy and banking policy. But which is the problem? The more central bank try to handle a multiple goals story, the more can emerge some trade-off unpleasant for the central bank with redistributive consequences for the real and financial economy. These redistributive consequences can change the traditional job of the central banks. And then here is that the relationship between politicians and central bankers came in, which is the idea. The idea is that in order to stretching the mandates, the central bank need a political support. And we call this story a sort of green memorandum between implicit contract between politician and central bank. Try to capture the story that I'm going to tell you. In a moment, we will see that the green activism of the central banks exists on one side, but is also heterogeneous from the other sides. Let me sketch out the two big central banks that we all know. On one side, we have ECB. We can say that it's really active in terms of green activism. On the other side, we have the Federal Reserve System. Almost silence on this. So how to explain this different attitude of the central banks? This is a presentation. I sum up a series of papers that I did with other co-authors in these last 3 years. And a couple of these papers are still in pipeline. Which are the facts we consider wondering how to measure the central bank activism. We have to take into account that usually in the central bank, we have two arms, monetary policy and banking policies, just as some statistics that recall you that usually the central bank are involved in both fields. How to evaluate in a paper, we try to, for our economies, there is a challenge. Try to transform a qualitative properties in a quantitative measure in order to use these metrics for our analysis. What we did in a paper, we try to measure this green activism of the central bank. And here in the slides, there is the lists of properties or activism that central bank can implement both in the monetary policy sides and in the financial policy, in the banking policy sides. Sum up all the information that we collect, we build up a green sensibility index that range from 0 to 14, and we show essentially two things: that in the last years, we check that effectively, in fact, we have an increased activism of the central banks, and the dates is exactly the 2015 of the Paris Agreement, just to give you the visual sense of the story. But inside of the sample, we have a really heterogeneity of green activism in terms of cross comparisons, and on top, also in terms of dynamics. Here I pick up some country. You can see that also there is some cycles. The central bank the same central bank became more sensible, less sensible. how to explain this story? This story can explain with a really general setting in which we can try to intertwine the economics part of the story and the political part of the story. Economics, we consider an economic system in where essentially in the real part of the story, we have brown and green firms. In other way, which is the idea that some firms, the green firms, are fit and reliable in terms of able to be addressed climate change challenges. The brown sectors, no. What the central bank can do, the central bank control both monetary and prudential policies. We know that the central bank can be green in both fields. For the sake of simplicity, we consider in this starting model just the green activism in terms of prudential policies. The more the central bank is active, the more there are cascade effects on banks, and there is one more cascades on firms. All the firms, both green and brown. Which are the consequences?
That's a clarification question.
It depends on the question. Please go ahead.
Let me try. It's a short one. So you're talking about previous, this one. Talking about environmental risks, but brown firms, which I suppose you're talking about oil and gas, they're not necessarily exposed to environmental risk, if you mean by that physical risk.
No, we are.
So I'm confused a bit about the separation between these two sectors, green and brown, and who is exposed to.
I try to be more clear in this economy. The key question is what the central bank can do. The central bank can influence the behaviors of the banking of the financial system. The first cascades, and the second cascade is on the economic system on the whole. And so in the economic system, you know, in order to be simple, you know that in the model there are white and black, and in the real world they're gray. But in order to capture the 50 shade of gray, we need to. That's the idea. But if you have another model, you can do. So given brown and green firms, which are the consequences of the policies, the consequences of both monetary and banking policies are in terms of output growth and inflation, which are the usual relevant variables. Which is the baseline scenario in terms of politics, a series of key assumptions. Politicians and central bank do not share the same loss function. Which are the government members are not the standard benevolent dictators, are politicians, are career concern play there. These are benevolent politicians, are helping hand politicians. They care about the overall community, but they care about election. In other way, one more step in future will be to take into account which are the consequences if we have politicians, we have grabbing hand politicians. That is, are captured by lobbies and constituencies, or for example, by brown firms. The central bank board are, again, no benevolent dictators, are bureaucrats that care about their career, and they can have different preferences. They can be hawkish or dovish, which is the overall institutional setting, mimicking the more general setting, at least in advanced economy. We have a monetary dominance regime. In other words, the central bank, from a legal point of view, is independent. The consequences, the more it's true that you have an independent central bank, the more it's true that you have to implement neutral monetary and banking policies, i.e. no redistributive consequences on the economy. Final and crucial consequences, actual independence can differ from legal independence. Just in a nutshell, in the tradition, there are this legal independence story. Here, this just an ECB table which summarize the more used indicators of legal independence. Grilli and others, 1991, and Kuckerman and others, 1992. But the more recent literature captured the fact that actual independence can be very different from legal independence. Usually the example are emerging and developing country, but it's not true. We can have political capture also in advanced economy, political pressure. Let me recall the tweet of President Trump against the president of the Fed. This is a form of political captures, political pressure. And the more you have political pressure, the more in the daily work, actual independence can be different from legal independence. In other way, there could be a relationship between politicians and central banks in the daily action. Then, how to model the implicit contract between politician and central bank. Let me compare a baseline scenario without a contract with a scenario in which there is a contract. Without a contract, the brown sector does not internalize the future output losses it causes. The central bank actual central bank behavior is perfectly consistent with the legal mandates. So the central bank implement just neutral politics, both in the monetary and the prudential fields. The government, the politician, acknowledge that exists a brown sector with overall negative consequences on the economy on the whole. And the government knows that the brown sector can invest in green technology, but it considers that there exists adaptation cost in the transition. Then two cases can arise. Take the perspective of the government. If the government feels that adaptation costs are higher than the brown sector negative spillover to the overall economy, the government became brown as well. It cares about voters, it cares about election. If the adaptation costs are lower than the brown sector negative spillover, the government becomes green. And then offer to the central bank an implicit green memorandum, which is this green memorandum is the contract that link the government, the politician, when the central bank is the legitimacy for the central bank action. And as in any WASH principal agent contract, there are the signs of the contract in which there is the usual, the standard stick and carrots divides. On how many? I have 1 minute.
No. You have 9. So you're eating into your Q&As.
9 is an eternity.
No, I know, but I'm just saying that you're eating on your Q&A.
So 9 minutes. The sign of the contract is the usual one. There is stick and carrots. The stick is the political stigma that the politician can make against the central bank through tweeting, for example, and the central bank, the carrots is the till factors penalizing the allocation of finance to the brown sectors. Then, how many equilibria we can have depends which are the preferences of both the politician and the central banks. And the outcome of the equilibrium can be interpreted alternative as an hostile or cooperative equilibrium. We have an hostile equilibrium when on the one side we have a green government and the other side we have a hawkish central bank. Central banker with dislike green policies. We have a cooperative equilibrium when we have a green government and a green dovish central bank. And so in a way, the green memorandum allows a dovish central bank to stretch its mandates to become as green as possible. In all this story, we have different sort of uncertainties. This has been another key words, in Nicolas' presentation. So it's a multiple equilibrium story, and you can jump from an equilibrium other, you can calibrate the parameter. Let me just comment two extreme cases. One, there is a nice case in which we have a green equilibrium, in the sense that the tilt factor losses are bigger than the adaptation costs, so there is an happy hand. We have a green equilibrium. In other situation, there is no convenience for the bronze sector to switch, notwithstanding the tilt factors. So at the end of the day, you have a brown restrictive policies which have both intended and non-intended, non-neutral consequences on all the economy. So on brown sectors that don't switch, and also on green sectors. In other way, you have intended and unintended redistributive consequences that touch firms, touch citizens means voters in our stories. So under some value of the parameters can emerge a green activity paradox. Green firms can be relatively more penalized than brown sectors. Conclusion. Facts, central bank in this year show a different degree of green activism. Possible explanation, the green activism is an endogenous outcome of a game between politician and central bank. There is a general set of rules in which formally the central bank is independent, but actual independence can be different from legal independence, and the consequences is that politicians can exert pressure on central bank. So at the end of the day, de facto, there is an implicit green memorandum between politician and central bank, which can be the theoretical extension. The theoretical extension can be considered also the grabbing hand perspective, that is, there are politicians that can capture the central bank action. In terms of exemption, the real challenge is to uncover which are the features of the politician and central banks in terms of green preferences. And one tool can be the text analysis that in our paper, my co-authors and me apply to understand which are the political preferences of the preferences of the politician, for example, between inflation and unemployment. The more we are able through text analysis to uncover the true preferences, the more we can transform this into a matrix, and given a matrix, we can do econometric exercise.
Thank you.
Thank you for your patience.
So
An applause, please.
yes,
Thank you.
Thank you.
Question? My friends, I don't know your name.
Stefano Battista.
Ciao, Stefano.
Should I go with the micro? Yeah. So thank you very much. Very, very interesting talk. I was wondering how much of that framework would have to be changed if you consider the following consideration. You were talking about activism as essentially green activism, particularly green policies that the central bank has to consider. But the moment in which climate risk is considered as a source of risk, then essentially there isn't much that has to be done in addition to the current, you don't have to change necessarily the mandate of the central bank. The moment you just have to change the way in which risk is measured. And so in fact, this is, the conversation about changing the mandate was 5 years ago. At some point, the idea entered that financial climate risk is a source of financial risk. And that's how, and therefore, it becomes an object of price stability and financial stability. We're wondering how much of that framework remains if you change, if you consider this risk channel.
Thank you. This is a crucial point in the sense you can say it is possible that this political pressure can become so harsh, and then also one of our assumption that the legal institutional framework is given can change. In other way, you can wonder, is it possible that also the mandates can become endogenous through this green memorandum, green interaction? Is it possible? It can be an interaction, but in our story, the mandate is given. And so the green policy, let me use again the metaphor, is a stretching of the mandates, and depending which are the preferences of the two players, the two sides, politician and central bank, you have the actual outcome. In other way, we try to explain, let me quote again the two big central banks, why so far the ECB has to be relatively green, and how and why the federal is less than green. Let me be elegant. But your problem is out of our actual setup so far. Thank you, sir. But it's an important.
Because you could interpret the difference between ECB and the Fed in the way they understand risk.
The problem is that uncertainty is that before you don't know how the climate change, because there is a climate change shocks. And so the green firms are able to address and fix. The brown no, and so there are losses for the overall community. Ex ante, you don't know the dimension and the distribution of the climate risk, and you don't know if the brown sector will adapt or not. These are the two main sources of uncertainty. It's a simple, but it's the first one.
I'll use my power to override you for a second and just say that in some sense, though, how you incorporate climate risks, given that it can be, you say we incorporate climate risks like there is a Bible, you go and read it and do it. The process, the way you do that can somehow hide a different perception that the central bank has, or the hidden mandate that is not explicit, but sort of implicit in the process that is used to incorporate the climate risks. So in some sense, it's a way of hiding under the carpet something that is actually happening, a difference in the perspective of how important something is to me.
Ernest.
Before I go into my two questions, I may contribute here, but Livio knows much more about this in detail. In the ECB, there was a big discussion whether the climate agenda should be subsumed under the primary objective of price stability. Climate change affects inflation, and therefore you should act. Or the secondary objectives and financial stability objectives. It's a risk, and therefore you need to become active. So this is a way, I think, a little bit what you may have meant, that you can, if you want to, legally integrate the climate agenda into the primary and secondary objectives of the ECB. But my questions were actually two different ones. The first one is, now the ECB, the Euro system is really a very complicated animal. You have multiple governments, some green, some brown. Then you have complex central banking systems, some ECB governance, favor of active central bank policy, against the ECB more in favor, I would say. So this is a very complex setting for this interplay, which I find very instructive that you presented and very, very good analytically. So how would you deal with this very complex, chaotic situation? And my second question is then, if I go back to big theories of history, what drives history? So it's institutions, or it's natures of law, so to speak, or is it personalities? And my question here is, how do you regard, or how would you integrate the role of individuals and their agenda and their personal convictions. Take President Lagarde. She made the climate topic her topic. Or take Governor Carney. So he was a forerunner in this respect. And also in the NGFS, there are some governors who really make this their baby, their agenda. So it's also personalities, individuals that drive the whole thing.
Thank you, Ernest. In our simple setup, we try to capture the different preferences in terms of dovish and hawkish. The dovish are the central bank, which are convinced that climate change is important, so they try to stretch as much as possible their mandates. Opposite is true for the hawkish. At the end of the day, and try to put together the two observations, here the intuition, it's really simple. There is no free lunch in the transition, in the sense that if you are a dovish, you can say there is a clear correlation between climate change and inflation, in the sense that the longer is the horizon, the more easy is this kind of correlation. If you are hawkish, you are completely disagree. You say, please be concentrated on inflation today and at least tomorrow. So given these costs, there is cost in transition. There is no free lunch. These are no neutral policies. And in order to implement no neutral policies, you need a political support. In ECB, I said, and I'm glad for this, that Christine Lagarde has been so far lucky, in the sense that in the end of the day, in the European Parliament, there are no opposition to this green activists on Christine Lagarde. I feel that the Fed neutral, to be elegant, an attitude reflect a political system in which the green activism perhaps is less strong and harsh. That's the simple intuition of the setup.
Okay, I think your time is up. We've eaten some of the lunchtime.
So
And
for this,
we thank you
for your question and your attention.
We thank you again. I'll ask Martin to come here. So our next speaker is Martin Oemke. If I mispronounce that, I'm not gonna eat your food at lunch, I promise. And he's a finance professor at LSE. He also is the director of the Financial Intermediation Research Society. And he recently finished the ERC and many other things, but we'll use the time for the presentation.
Thank you very much, Valentina. Change it to full screen. Yeah, thanks. Okay, thanks for inviting me to speak at this conference. So I'm going to talk about capital requirements, so bank capital regulation. So relative to the previous talk, we're going to narrow down the scope a little bit and talk about one particular regulatory tool and how it relates to some of the issues and risks also that we've been discussing today. So this has become, as we all know, a big topic of discussion among central banks and financial regulators. The ECB, Bank of England, Fed are all thinking about these issues. And I guess as a general statement, how involved or active central banks, financial regulators should be is still, I would say, a controversial topic. I think that's true both in the kind of regulatory arena, but also more broadly, even also among say academic researchers. And so the objective of this paper, which is a joint work with Marcus Opp at the Stockholm School of Economics, is to zoom in on the capital requirement question and put down, if you want, a conceptual or develop a simple conceptual framework that's going to allow us to think about capital requirements as a potential tool in this field. And I want to separate, I guess, and I hope that's useful, two parts of this discussion. One is the risk discussion. So to what extent and how do capital requirements work in addressing climate-related financial risks? And the second issue, which goes beyond that, and this comes back to the last talk about, where do we draw the line of the mandate, but a second potential objective, which is can bank capital regulation also be a tool to deal with emissions that are causing externalities? So, and I'll get into both of these as part of this talk. Let me start, given this is a short talk, and in the theory paper, you never know, do you get through all the stuff? Let me start kind of with the high-level takeaways I would like to have you walk away with. And the first is that our view, based on this model, is that if we're looking at climate-related financial risks, or risks to the financial sector, that's actually something that can be dealt with using capital requirements. Perhaps, you might say, yeah, well, that's not that surprising because capital requirements are there to deal with risks. And to some extent, fundamentally, that's what's behind the statement. Of course, even though conceptually it's not different from other risks that we use capital requirements to deal with. Of course, here, one of the key challenges, and that goes back to the first talk we saw this morning by Nicola, is that estimation is harder. This is going to be much more forward-looking than some of the other things we've been doing, but conceptually something that capital requirements can do, taking into account, say, insights we gain from stress tests and so on. Now, one, I think, interesting thing here is that of course, addressing these financial risks, say in the banking sector, prudential risks, is not necessarily equal to lowering emissions, right? So what I'll show you in this framework that we're developing, if all that you're worried about is how big is the buffer, for example, that a particular bank has, then actually, if you're asking the bank to increase that buffer, it could be that what you're crowding out at the margin could be loans to green or clean firms, right? And so I think it's important to keep that distinction in mind. Now, when it comes to the second potential objective, can we use bank capital regulation as a tool to help the transition to a lower carbon economy? There, what I'm going to argue is that, particularly if you compare it to more direct tools like, say, carbon tax, capital requirements are not going to be very effective here, even in cases where actually the regulators can easily or perfectly measure the associated externalities. And there are a number of reasons for that. One is that in a well-capitalized banking sector, this is a relatively blunt tool, and I'll talk about why. But even in other cases, if you make it harder to get loans to fund high-emitting activities, there might be substitution to, say, public markets, to bond markets, or anywhere else outside the banking sector, maybe private equity or whatever it might be, right? So there's this kind of spillage or slippage here. And then even if you can impact the activities that are funded through bank capital requirements, and this comes back to the previous talk about trade-offs that arise once you have multiple goals, is that this may involve sacrificing part of your other goal, the financial stability goal, right? Lastly, if I have time, I'll talk briefly about where we do think that capital requirements can come in this kind of transition story. Which is essentially a political economy story, in the sense that if governments are reluctant to act more forcefully, for example, in raising the price of carbon or carbon taxes, and if that's because they are worried that doing so is going to lead to a materialization of transition risks, which are going to impact the banking sector, then if beforehand you make sure that you have sufficient capitalization in the banking sector, you alleviate this commitment problem, and governments, it's going to be credible for governments to act more forcefully. Okay. Let me briefly talk about what goes into this model. So this is, if you are familiar, with this line of research, typical kind of very simple banking model. It's just a one-period model. So we're more interested here in qualitative than quantitative insights. There's a number of firms, a continuum of firms out there In the baseline model, they only have one way they can fund themselves. They have to go to the banking sector. And there are two types of those firms, clean and dirty. They invest at date zero. They have to put down some money to invest in a productive activity. They're initially cashless, so this funding has to come from a bank here. And then they can invest and they get a risky cash flow. And they have this cash flow distribution depends on the type of the firm. And so the baseline model that we analyze here, I think, or the idea is to capture at least historically kind of the trade-off that I think we're dealing with, which is that for the firms, if they were just to look at their financial profitability, well, then the dirty technology or the dirty firms are more profitable, but those are also associated with higher emissions. So there's going to be a trade-off here in this model between, you can reduce emissions, but it's going to be financially costly, or you can, fund cleaner firms, but they're not going to be, on average, as profitable as the higher polluting firms. These firms go to banks. There's a continuum of banks that can fund investments. Banks have some amount of equity. Of course, how many loans they can make then depends on the capital requirements per loan. Why are there capital requirements? The typical reason is in these models that, well, there's also deposit insurance somewhere in the background here. And so that implies a transfer if it's not perfectly priced to the banks. And so you use capital requirements to deal with this distortion, right? And so these capital requirements are going to be set here by a regulator. A regulator can be, the regulator can set, if it wants to, separate capital requirements for the loan to the clean or the dirty. Okay, so I'll show you a little bit of just preliminary analysis of what the equilibrium looks like in this model, and then I'll talk a little bit about policy, both in terms of just what would certain interventions, higher capital requirements for firms or lower for non-polluting firms do, kind of at an ad hoc basis, and then briefly talk about under different mandates, a classic prudential mandate or a mandate that also includes the objective of reducing emissions, what policy would look like and what you can and cannot do. Equilibrium here, right? There's going to be some equity in the banking sector. The bank has that, or the banking sector has that. It's exogenous here, and then firms use that when they ask for a loan. This equity is used up because the bank has to use it for their equity requirement, right? And so fixed equity supply curve, we have an extension where you can endogenize that, but there's let's say in the short or medium run, fixed bank equity. And then what is the bank going to do, or what is the demand curve, I guess, going to do here? When you look at all the loans that you can make, in economics, usually you think of, demand curve, well, consumers' willingness to pay, for example, right? So here it's similar. The bank was going to think about, okay, what's the maximum return on equity I can get on a unit of bank equity? And so the bank will kind of rank all the loans and then start making the loans starting with the highest return on equity. You can calculate in that model what that is. It's going to intuitively depend on how profitable is what the firm does, but also how large is the deposit insurance put. In other words, kind of the transfer that the bank gets from this deposit insurance from the unpriced deposit insurance. And so they're going to rank firms according to this ROE or maximum ROE, and then start making loans. In a picture, right, it's going to look something like this. I only have two types of firms here, and they're kind of all the same. So it's going to be this demand function. It's going to be a step function. Suppose you set equal capital requirements for the dirty and clean firms, then, well, because the dirty firms are more profitable, those loans are going to give you a higher maximum ROE, so they're right here. At some point, you funded them all, then they're the clean firms right here with a lower ROE because they're less profitable. And then the equilibrium would be somewhere where that step function, that demand function, meets the supply function of bank equity. All of these more profitable but polluting firms are funded in this illustration, and then you fund some of the slightly less profitable clean firms until you run out of equity capital. You could do that. Clarifying question?
Want to come here with this?
So it is risk-adjusted returns. It is risk-adjusted returns, especially with respect to carbon risk.
With respect to carbon risk?
Yes.
Well, so risk in this model, so it's a risk neutral model. So the word risk adjusted, you know, so there isn't, if you want, a risk premium in this model, because for simplicity we have risk neutrality. But of course, what is taken into account, you know, these cash flow distributions are risky, right? And then, of course, in pricing the loan, the bank has to think about the loss distribution of those loans, and that's taken into account here. And in fact, one of the things I'll use when thinking about climate risk is essentially vary that distribution. So in that sense, yes. Okay, you can, you know, if you don't like the step function, you know, you can have a more kind of heterogeneous version of this model, or continuous version, where you have a more continuous demand function. On average, the polluting firms are more profitable, but, you know, it doesn't look quite as extreme. And so that's something you can look at in the paper if you're interested in. But let me use my remaining time to talk about policy in this setting. And let me first quickly talk about what would happen if you do something like a green supporting or a brown penalizing factor, lower or higher capital requirements for clean or high emitting firms. That, of course, is just ad hoc for now, and then I'll use the last 2 minutes to talk about under a certain mandate what would be optimal. So this picture I just showed you kind of lends itself relatively nicely to thinking about how does the equilibrium change here if you change capital requirements. So, for example, suppose you raise the capital requirements for high polluting firms. This is essentially the picture I just showed you, and the dashed line is you know, where you start out before you change the capital requirement, and then you say, well, okay, the polluting firms now, higher capital requirement, what's going to happen? Well, the ROE they can offer is going to decrease now because they're using up more bank equity capital per loan, and also because you're using up more bank capital per loan. If you want to fund all the high polluting firms, you're going to be using more of the banking sector's equity capital, right? And so, in fact, if you just put a small change here, what you can see is, yes, that line shifts down and becomes longer, but actually in terms of who gets funded, the changes that you're pushing out actually at the margin the clean firms in this case. Now you can say, well, let's keep increasing the brown penalizing factor. At some point, of course, in this two-type model, you're going to reverse the ranking of the firms. That's what I'm illustrating here on the right-hand side, where then now the brown penalizing factor is so large that you actually fund the green firms first, and then afterwards the polluting firms. You can do a similar analysis for reducing capital requirements for green firms. Let me not spend that much time on that, except saying that now at the margin, the opposite is going to happen, right? So you're not changing the red line in terms of up or down or its length, but you're going to make the green firms more attractive and also shorten that line. And so some of the firms that were right here that weren't funded, if you start reducing the capital requirements, they're going to be crowded in at the margin, and at some point again you get this reversing of ranking. Now, what does it tell us about optimal capital regulation? Let me start with if you want, classical mandate. You could say, okay, let's give the regulator what looks like a classical prudential mandate, where the bank regulator likes the fact that the banking sector intermediates loans and those loans fund positive NPV projects, but the regulator does not like the risk to the banking sector, which in this model is captured by this deposit insurance put, or the possibility that you might have to bail out the banking sector, right? So you don't like the kind of any reductions in financial stability that increases the second part. Now, you can feed in the model I just showed you. Actually, in this presentation, the math isn't that important. It's just kind of to fix ideas. What the regulator is going to do is set these two capital requirements in order to maximize. Another, one way to think about it is, well, every unit of bank capital, let's make sure that contributes, if you want to get the biggest bang for your buck in maximizing this objective right here. And so the only thing I think to take away is that, well, how do capital requirements and how do also there was just a question about risk, right? Climate-related financial risks enter into what you do to capital requirements. Well, if climate risks, for example, reduce future profitability, say transition risks of certain firms, of say the polluting firms here, that's going to show up here in the NPV. If they increase the risk of these firms, it's going to show up in this deposit insurance put, which depends on the riskiness on the right-hand side here, right? And so that allows us to, you can then go through that model, you can ask, okay, let's calculate the optimal, prudentially optimal capital requirements, and again, do a before and after analysis. So the thought experiment I have in mind here is one where the solid line is, let's say, based on a world where we've been backward looking and saying, well, what were the historical default frequencies? And now we do stress tests and we realize, and that's the experiment I'm showing here, that, well, for some firms, in this illustration, the high polluting firms, there is transition risk going forward. They're going to be particularly affected. How do we change capital requirements to incorporate this additional risk? And as you might imagine, the capital requirement is going up. So here I'm plotting, depending on how well capitalized the banking sector is, what was the original capital requirement, and then how it is shifting up. On the left-hand side here, what I'm showing is moderate transition risks where capital requirements do increase, but you can see there's no shift yet in, it's not optimal yet for the regulator to try to shift the ranking of the two, whereas as you start increasing the size of these transition risks, at some point, actually, the prudential regulator will try to reverse the ranking here. So the model, I think, shows there's a difference between moderate risks, where mainly what you care about is how big is the equity cushion that banks have. And when that's all you care about, then if you're in a particular region here, you actually do what I showed earlier on. You might actually raise capital requirements knowing that this might crowd out some loans to clean firms. But then at some point, if transition risks are above some threshold, you actually want to also affect how banks rank these different investment opportunities. Now, last thing I want to show you is, well, what about lowering emissions via capital requirements, right? So now the prudential, you're stepping outside of the prudential mandate. There's this additional term, you care about the externalities, the carbon emissions themselves. And so just to give one example, given the short amount of time left, consider a case, well, then where the high polluting firms are such that you actually don't want the banking sector to fund them, their social value after you account for their carbon emissions is negative. And here, I think there's an interesting, contrast with the regular kind of deposit insurance distortions we're worried about, because if that's what you're worried about, you can always get rid of that by asking for a high enough equity requirement, because that distortion, once you go to, say, in the extreme, 100% equity is gone. But that's not the case for externalities. So if you are raising capital requirements to try to not have firms fund projects with high emission, then, well, if those are profitable projects, and as long as the banking sector is sufficiently well capitalized, they might actually continue to fund them. If bank capital is limited, then actually you might be able to push these out of the banking sector. But actually, what you might have to do that is at the same time lower capital requirements for other loans, for the green loans, beyond what you would do under your prudential mandate. That comes back to the earlier talk, where suddenly now there's, I guess, one way as economists we think about it, right? You have one tool now, but two goals, and so inherently you're going to end up in situations with trade-off, right? So finally, let me conclude on just a slightly more positive note, because I think in terms of what can bank capital regulation do in terms of helping with transition, and this is what I alluded to at the very beginning when I was also, like the previous speaker, talking a little bit about the political economy angle. So even though as a direct tool, capital requirements are not effective in our model, if you extend the model to think about kind of this interplay between, say, governments and financial regulation, then capital requirements can have an indirect, what we call facilitator role. So if the friction is that governments are unwilling to act because they're worried about financial stability, then if you make sure that beforehand you increase the resilience of the financial sector sufficiently, then you make it credible kind of in this commitment problem world for the government to actually move. And so, of course, this requires specific conditions. It's not a blank check for intervention, but this, I think, is one angle where capital requirements not only can help with the risk, where, subject to measuring it and doing the right stress test, I think they're going to be very helpful, but may also help in this indirect route with the transition. And I'll stop right here and look forward to the Q&A.
Amazing timing. Yes.
So super interesting paper. Thanks a lot. I'd like to ask you a high-level question in the context of the paper. So basically, capital requirements are there with respect to a specific externality, which relates to basically financial instability. If you can have spillovers from one financial incident to become systemic risk. So that's and also to bring skin in the game of the lenders, so that they cannot shift too much risk to the rest of society. Hence I win, and the other side you lose type of logic that we were discussing at the time of the great financial crisis in particular. So now you are talking about another externality, which relates to this climate transition, and how this financial regulation instrument, policy instrument, can be used with respect to this other externality. And I'm not sure whether this is the proper instrument vis-a-vis this other externality. And again, but this will be more for lunch in terms of the type of risks that you cover here. If we go back to Carney's speech, which was that Nicola mentioned earlier, one of the big risks seems to be in the transition that there would be a run on brown firms, and possibly faster than socially optimal. So is this part of the going back to this risk-adjusted returns? There's an externality which is financial, increasingly financial, because you can have a run like you can have a run on deposits. And how are you thinking about this risk with this type of framework?
Can we collect?
Yes, we maybe collect a couple of questions. Yes, I'm just reading while the microphone goes around. A question from I think Marco today, but I cannot see the full name. In your opinion, what will be the effect on price to book value of increasing the bank's requirement in order to address climate risks?
Thank you. It was a really interesting talk, and I have more a comment than a question. So in Europe at least, but I guess it's the same in other jurisdictions. So there is no authority that has the objective to green the financial sector. So this is sometimes is a misunderstanding. So for example, the ECB can only intervene on the prudential side, but we don't have a mandate to green the financial sector. So an argument that we always use is that there is a divine coincidence, that the actions that are needed on the prudential side are also those that lead to green the financial sector. But your paper is to suggest that this is not the case, namely that the capital requirement implied by the two objectives is different. So this poses the question. So the capital requirement that you get from only a prudential perspective is different and perhaps lower than than having the objective to green the financial sector in mind. But then my question would be, is this, so if you overweight the prudential side, so if you overweight this side, you come closer to, is it isomorphic to the objective to green the financial sector? So the one that you have with the carbon externality. Because this is the argument we make. So the argument we make is that by being very aggressive on the prudential side, we also do some part of the greening that is not in our mandate, but is still desirable. So that's the big.
Last question. Nicola?
Thank you. Very nice presentation. Before I ask my question, could you quickly go over the final point again? Because you went very quickly on that in the last slide, and I didn't quite understand the indirect role part. But my question was, so from talking to financial institutions, one of the bigger, so we come back to Stefano's point earlier about the sort of risk perspective, and is the risk perspective enough? From practice, what we hear from financial institutions is at the moment one of the big differentiators between clean and dirty at the moment is the clean technologies. They're having to apply much greater risk ratings on them because they don't have the data to assess the risk properly, whereas fossil fuel companies have been around for decades. So actually they sort of win out in that sense, in that other component of the risk equation is coming up lower. And at the moment, the balance that we hear from them is that, yes, they're analysing transition risk, but because of this historical risk data issue, under the current regulatory regimes, they're having to put more risk weight in on the clean firms. And I was wondering if you brought that into your thinking, in how that might change things.
So to regulate this, I would suggest that the first of our larger scale question is addressed at lunch, and then you take, one of these. And there's another question from online, which I will give you later, and you will receive a reply, but through an email.
When will you like?
Minus 16. No, I'm joking. You have 2 minutes.
Yeah, that's fine.
3.
So, let me quickly talk about the mandate. So the mandate, Livio's question or comment. Here we don't take an explicit stance about what the mandate should be in this paper. So essentially, we were trying to explore 2 different mandates, one that includes the carbon emissions, one that doesn't. Livio is pointing out that, well, there is this argument that maybe there's this coincidence that you deal with the first one, the prudential, and you also do the second. And the observation, Livio, is right, that that's not the case in this model, right? So, for example, one of the cases I tried to highlight was that sometimes you want to deal with the prudential issue and you raise capital requirements for the high polluting firms because of transition risks, but you are actually working against the transition because you are pushing out, under certain circumstances, this model, the clean firms at the margin. So there is no, this divine coincidence is not here. Now, whether the ECB could have a different mandate is a discussion for lunch. Then we have to talk about the secondary mandate and so on. I'd actually be interested in your view on that. But our analysis would say actually this is maybe not the most efficient way of dealing with reducing the emissions. On Nicola's point, I did go a little bit too fast at the final slide. Here, the idea was just that if governments are worried to move, because a lot of times you hear this point, particularly talking to central bankers. I guess also the first thing Lagarde says is, well, first and foremost, governments should deal with it, right? And then if we think they're not acting fast enough, one reason might be that they worry that if carbon price goes up too fast, if carbon taxes go up too fast, that this might be an issue for the financial sector and you cause a banking crisis. And so the point in a way is a simple one that, well, if that's the worry, then if capital regulation makes sure that there is a lot of resiliency, a lot of loss absorbing capital in the banking sector, then governments might be more willing to act faster. I have not looked, interesting point you raised at the end about that the backward-looking nature might also mean that there's this other reason why clean firms are disadvantaged. We have not looked into that, so it's something actually I'm interested in. So we will start looking into that, because that would be another interesting, I think, channel to think about. So thank you very much for all the questions. Everybody's questions I did not answer over lunch. I'm very happy to chat as much as you would like, and thank you.
Thank you. So our last speaker is joining us remotely. So Andrea Polo is a professor at Lewis School. Are you there? Can we try? Now you have to unmute yourself.
Hello, can you hear me?
Yes, this works.
Perfect.
So Andrea, I've already mentioned that you're a professor at Lewis School, a professor of finance, and I leave you the floor so that you can tell us whatever you want to tell us.
Many thanks for putting this paper in the program. I do apologize for not being there with you. I would have loved to be there with such a great group of people that you put together on this topic. Unfortunately, I have a kid going to the kindergarten, and he comes home with all sorts of viruses, the name you have probably never heard of. And so I'm a bit stuck with the flu, I'm sick because of that. Okay, so let me so there's a paper with Carlo Altavilla and Miguel Busigna from the ECB and Marco Pagano, the University of Naples. So we ask, so in a sense, this will probably resonate with many of the things that we discussed this morning. The first thing that we ask in a more like positive analysis, relative to some of the things that we've seen before, is whether banks, care about this climate risk, do they price in their loans, and whether this is over and above traditional credit risk. Okay, this is an important point relatively to some of the things that have been mentioned, in particular relative to the paper Martin by some of the people from the audience. Okay, so I will tell you more about what I mean by that. And when assessing climate risk, in general, banks, do they care only about current emissions? Okay, so by climate risk, I'm talking about transition risk, carbon risk, okay? Or do they also consider firms' plans to reduce emissions, that Elena before hinted at? And who does it more? So if we find that indeed there is some pricing of this, who does it more? So are the banks who themselves commit to this environmental protection, to charge higher lending premium on climate risk or not? So this is the first part. And then we're going to answer another question, whether monetary policy affects the pricing of this climate risk. Okay, and here really two alternative views with opposite predictions come to our mind. So there is a view which hinges on the financial friction channel, by which there is the idea that low emission firms have fewer tangible assets. Sorry?
That is not an improvement. Wait.
Hello? Can you hear me?
Andrea, scusaci, just give us a second. We're fixing, because we were hearing you and it was okay. It was better than this, definitely. Andrea, can you try to speak again?
Yes, can you hear me?
Like before, which is I think the best we can get, which is fine. It's okay. Go ahead.
Okay. Is it okay? Is it okay now?
Yes.
Okay.
Okay.
Can I continue?
Please go ahead. Please.
Yes. So I was saying that there are these two views for which we, before embarking the study, we were not really we were knowing which direction we go, because if this financial friction channel suggests that firms that green firms have fewer tangible assets. This is being shown by people at Bocconi. There is a paper by Julien Sourignat, Torsten Martin, Luigi Iovi, who show that low emission firms have low tangible assets or less collateral. So if this is the case, according to this financial friction channel, which goes back to Bernanke and Gertler, monetary tightening should discourage more lending to these firms. Okay, so high tightening monetary policy prompts banks to raise rates more to firms, to the green firms, to the one exposed less to climate risk. While there is instead another view which hinges on the risk-taking channel monetary policy, which suggests that monetary tightening should discourage bank risk-taking. And if this is a sort of risk-taking, so there should be some sort of climate risk-taking channel of monetary policy. So if there is a tightening, this should increase rates to firms, and this is particularly true for the high risk, high climate risk firms. Okay. So what do we know already about this? So there is evidence that security markets price this sort of carbon or slash like transition risk. Okay, this evidence in the stock market, in the option markets, in the bond markets, despite the fact that now recently there are some people who question this, the evidence of this greenium, the premium on the green bonds, but there's a lot of evidence on security markets, while for credit markets, the evidence is more ambiguous. Okay, so this has been traditional. So we've only seen evidence papers on syndicated loans. Syndicated loans, as you know, is a small fraction of the loans given by banks, and in particular, these are typical loans for particular purposes, for instance, for M&A. So these are very kind of somehow special loans. And here also for these syndicated loans, there are some papers which say, well, no, there is no evidence. Now there is a BIS paper which says, well, after the 2015 Paris Agreement, there is pricing of these carbon risk. Also, there is no consensus whether banks committed to environmental policies lend preferentially to low emission firms. They are true to their words. There is the same paper that I mentioned before on the BIS say, well, if you look at these committed banks, well, actually you don't find any difference. There is a recent paper by Mariassunta Giannetti with co-authors of the ECB, and they look more at whether banks which disclose, which in their disclosure, they try to look more green, whether indeed they walk the talk. Okay? And they found there's no evidence of that. While there are other papers which say, no, the banks which commit with this net zero alliance, indeed are the one which try to incorporate these more relatively to banks who don't commit. Okay, while as far as we know, there is no evidence on the impact on monetary policy on the pricing of this carbon risk. Okay. So we go with the data. So what we do is that we use the monthly loan level. Loan level data from the Anacredit database, which is the European credit register from September 2018 to December 2022, because this is when September 2018 is when this project of Anacredit started. And we merge this data with the Refinitiv, for which we know at the firm level with the scope 1 and scope 2 emissions. And then we use this, so Refinitiv, part of the GHG protocol, they disclose also whether they have an emission reduction target. Okay, so some firms have an emission reduction target, some firms do not. So we use this as a proxy of whether they have a target for the future, so they plan to reduce emissions in the future. Okay, now this variable, so it's been used by other papers, in particular there's a paper by Bolton and Kaspersisk who show that indeed the firms which disclose these targets indeed reduce emissions in the future years. Interestingly, they find they have this study like worldwide, and they find, okay, seems great news, but how come that we don't say great, aggregate evidence? And they show that for North America and Asia, the firms which commit to reduce are the ones which don't produce high emission to begin with. Okay, but while they find that this is not the case in Europe, indeed, the high emitters are the ones which tend to have more of these disclosure. This is also what we find. Okay, so we complement this data on the commitment on the side of the banks. Okay, so here is these if they ask other people's using, so the variable that we use here is whether banks are signatories of these net zero alliance. Okay. And then for monetary policy, we use high frequency monetary policy surprises, as is typical from this literature on the impact on monetary policy. Basically, we're going to use the exogenous change, in interest rates in the 30-minute window around the ECB press conference. So just to give you just a few numbers. So, for instance, for carbon emissions. So the way we're using carbon emission, we're gonna use these divided by, so scaled by net revenues, and the number for high polluters. So let's say 90 percentile is 530 tons of CO2 emissions out of net million of US dollar revenue. And this is smaller than if you took a worldwide study, like some of the papers that I mentioned. Okay, for instance, in the paper of the BIS, if you do a similar study for syndicated loans, the number will be double, okay, because there are more polluters in North America and Asia. Okay, so how many firms disclose this target? 58% of our firms disclose this target reduction. Only 11% of our observation belong instead to banks, which themselves are signatories of these net zero alliance. Okay, so we're going to look at the spread, okay, as a dependent variable. So the spread means what is on top of the, say, Euribor, LIBOR, okay? So it's the spread charged by the banks in the loans, okay? So what do we find? So if we just take the data without touching them, we show that indeed there's evidence, at least on the descriptive level, that firms with low carbon emissions, they are charged less. Okay, so you see the green is always below the red in the right, in the graph on the left, which is about current emissions. Okay, low current emission is the green, and they get charged less in this sample period. If we go on the graph on the right, instead we'll look at this forward-looking. The firms, these 58%, so the green are the 58% of firms which disclose a target. Okay, and they are charged less rather than the ones who don't disclose a target. Now, this of course can be a composition. These firms could be different in terms of risk, okay, or in terms of traditional risk. Maybe these are just high leverage firms or firms with different liquidity, or firms with some other unobservables for which they are riskier. So what is important for us in a regression type of analysis is to control for other characteristics. And what is nice is that we have an over-encompassing measure of traditional credit risk. This is the probability of default assigned by the bank to the firm. Okay, so and if we control for this variable, we find, and we use, and we look at carbon, so current emissions, and forward-looking, whether they have a target. We find that indeed all three variables are priced in. So of course, higher firms with higher PD have higher interest rates, but also firms with higher carbon emissions, and also firms which disclose a target, they get charged less. How large is this? So we're talking about 4 basis points for the polluters. Now, is it large? Is it small? So consider that the standard deviation of this is only 76 basis points. Okay, so this is 5% of the standard deviation. This number, by the way, is exactly the number found in this BIS paper that I mentioned for emission in syndicated loans. While we look also at this disclosure target, and so if they have a target, this is 10 basis points less. Also, to get the sense of, to get around these numbers, consider that, for instance, PD, which is a traditional measure, important measure of credit risk, is only like 3 basis point premium in this sample of companies. Okay. Okay. Now, maybe later on, for in case there are there could be questions of this. So, for instance, an interesting question relative to the discussion we had before is, okay, why banks do not, if they have concern about these emissions, probably this shouldn't matter for their PD, right? So why they don't put emissions within their assessment of the probability of default, okay? So there's several reasons why we think that they don't do this. But maybe I can, if there are questions about this, I can enter later on in the Q&A. Okay. Now, so we have several specifications because for us was important not to, as we say, to control for many things. So here, what we were scared now is that we are comparing maybe just different industries. You know, there are industries, oil and gas, where there is a lot of emissions, and industries where there are no emissions. So here, this is what we capture with this first coefficient, but then we introduce this sort of fixed effect like industry, location, sector. So this is within the same type of firm. So firm in the same industry, in the same location, in the same size. If you have high emissions, you get charged more. And finally, we leave the last specification is even with firm fixed effect. So it's the same firm, but when they increase emissions or reduce emission, there is a change in price by the banks. Okay. Now, there's similar results if we remove this probability of default and we add firm observables. Okay, for us, PD is nice because it's an overall encompassing variable, you know, of everything which is credit risk. But we can remove it and add firm observable. We find the same. Only results are the same if we use only non-government guaranteed loans. This was a time now when in Europe there are a lot of guaranteed loans. We class it and they're differently. Okay, so now we've seen that there is a pricing. Are the banks which commit more the banks which charge for which this carbon premium are larger? And the answer is yes. Okay, so we find that, so if we look at the commitment by the bank and the emissions on the commitment by the bank and the target, we interact them, we find that indeed the one which the banks which commit, they charge 16 basis points less if the company has a target, and 2 basis points more if the company has high current emissions. Okay. Now let me go with monetary policy. So the question here is whether there is a tightening of monetary policy. So look at the first column. Whether there is a tightening monetary policy, whether the spread increase, and whether increase in particular for the risky, the high climate risk guys. Okay. So here, if we don't put time fixed effect, I can see this coefficient. So if there is an increase in monetary policy, the tightening of monetary policy, indeed there is an increase in the spread. We know from other studies, and we see here the traditional risk-taking channel of monetary policy. Okay, so this effect is particularly large for risky, high risk, high PD firms. Okay. So you see that the monetary policy NPD is the so-called traditional risk-taking channel of monetary policy. But on top of that, if we add these two variables that we have, no, we see that this is also true for these other two variables. So for this other source of risk. Okay, so current emissions and target. So if so when monetary policy tighten, increase rates to everybody, in particular for the one which have high emissions, and less if they disclose a target. So how much is it? So 25 basis points for price, increase the policy rates of 35, increased spread of 35 basis points, meaning for everyone, but there is an additional 1.4 if you have high emitters, or a decrease of 5 basis points if you are committed to lower emissions. Now, with monetary policy, there is always the issue that monetary policy, as Bernanke told us, acts with lags. And so, in order to capture this effect, that maybe what we're seeing is on the effect on the day, on the month, but what maybe if there is a lagged effect. So for this, we look at this. We use this local projection, which is a methodology to look at these to look at these dynamics. And when we look at the spread, we find that indeed the spread increase on the spot, but then they increase more the following months. For carbon emission, we don't find much. We find that these 1-2 basis points. This is what we find. Also, if you look at the following months, but this number for target increased to 9 basis points after 12 months. Then we also wanted to look at what happened to quantity. We've said a lot about prices, but what about quantity? And here we find that on the same time, so nothing happened. You see that the volume does not change when you change the monetary policy. You see the first time t, but then we see the lag. Okay, we start to see the lag. So the 25 basis points, nothing. They don't do much at the moment in terms of changing quantity, but then after 12 months there is a decrease of 2.5% of additional lending, and this becomes an additional 2.7% drop if you are a polluter, and a mitigation of 1.5 basis points if instead you are someone who commit to reduce emissions. Okay. Now,
just to tell you that you've entered your 10 minutes Q&A time. So
I'm done. I'm done. So the timing then I calculated well, because basically I just want to say that this is a methodology based on high frequency shocks, but actually results very similar if we do a diff around July 2022, which is when the moment when rate starts to increase. So just before concluding, just one slide. So actually, we also ask banks, okay, about this. So for the first time, the ECB in July 2023 asked in their normal bank lending survey, whether in the previous year how they treated bank firms which they consider brown, green, or in transition, and consider that 2022 was exactly the year of the July 2022, 2023. It's exactly a period of very high interest rates. And what we find is that consistently, of course, we do not have a time series here. We only have this one moment. But in this July 2023, they said that in fact, in the previous months, they've been particularly harsh versus brown firms, and then they favor more these green firms or green in transitions. And by the way, results are also are stronger again for the committed banks. So the one in blue are the one the banks which commit. In fact, we find in particular for green and firm in transition, this seems to be one that favor in particular this type of firms. Okay, so to conclude, so euro area banks seems to price climate risk, higher rates to firms with larger emission, lower rates to firms that commit to green transition. Banks' commitment seems to matter. So committed banks are indeed the one for which this, what we've just said, is particularly true. And we can provide some evidence of the so-called climate risk-taking channel of monetary policy. Contraction in monetary policy, in fact, lead to higher premium, lower volume to high emission firms, but this is less the case if instead they commit to decarbonization. So just the bottom line, since there is, in particular in central banks, there's a big debate whether monetary policy, tightening monetary policy is lowering the transition. This speech by Isabel Schnabel on this question. So what the evidence we provide here is the following. So restrictive monetary policy is true. It increased the cost of credit to all firms. Okay. So in this sense, like it penalized firms who want to invest because they want to to do something with their to change their internal strategy. However, this contractionary effect seems to be milder for firms with low emissions and for those to commit to reduce them in the light of these risk-taking channel monetary policy. Many thanks.
Thank you, Andrea, for giving us this great presentation. Although you're not well, we feel it. And so I'm gonna open the floor for questions, but we're gonna need a mic, otherwise there's no way he's gonna. He's not seeing you, so you'll have to tell your name.
Andrea, can you hear us? Can you hear me?
Yes, very well, very well.
Congratulations, thank you very much. Very interesting paper. Super short comment when you say, there's evidence of pricing, but then eventually you provide this list eventually typically is a few basis points. So if climate risks were priced in fully, we wouldn't be here talking about it. But coming apart from that, the question is to what extent, if there is pricing, to what extent is the pricing? That's what you're actually looking at in your paper, which is very interesting. Could you explain a bit more why is it that condition to the monetary policy, then what is the channel by which then there are higher premia on the high emission firms? How do you thought develop a theory of why is it happening? So that if I understand right, proportionally the high emission firms get charged a higher premium in presence of the monetary policy, which is neutral to the climate risk per se. So why is it happening?
Do I answer or do you collect?
We're collecting
questions.
A couple of other questions.
Hi, this is Brunella Bruno. Ciao, Andrea. This is Brunella from Bocconi. I have two questions. One is about the target. I might have missed something, but is it a dummy variable that you have in? And if so, the positive effect you find, it is the reducing effect on premium is because of a transparency mechanism that you have in mind? And if this is the case, what if a firm is distant from the target? So the message is I'm like reporting that I have a target, but I'm very distant from, or relatively distant from, that may have a different, impact, and also the channel should be working a different way. And then how do you measure commitment? Because as you said, the extant literature has no conclusive evidence on that, but perhaps this also depends on what you consider for committed banks.
Hi, it's Mauro here. I work as a financial data scientist in a consulting firm, and my question is just like a curiosity actually. And I was thinking, like, sorry if I misunderstood something, but in terms of the analysis, how do you analyze companies that are very complex, such as, I know this is not the case, but if I think about, for example, Berkshire Hathaway, this is such complex. They have so many subsidiaries, and many of them are so high polluting, and many of them are very low polluting. So that's something maybe to take into consideration. Thank you.
There's a question from Elena.
Hi, Andrea, this is Elena. I have a question. First of all, thank you. This was a very interesting presentation. I have to say, I'm a little bit surprised that you find so much pricing in the loans for climate risk. So I was wondering, because what I hear, at least from the bank I'm in most contact with, is that, of course, for them, it becomes a competitive advantage. If they are the first starting pricing them in, then they are at the competitive disadvantage with the others. So I was wondering whether this pricing is homogeneous or it matters whether, or heterogeneous, whether it matters that it's concentrated in a particular country or sector or relative to be more idiosyncratic in a way, if you see what I mean. And the second one, I think banks respond to monetary policy, but what do they respond, or they seem to respond a lot, is to speeches of executive board members. And in particular, when it comes to climate, they seem to respond enormously to Frank Ederson's speech. So I wonder whether there is a way in which you could incorporate that as well.
We have just one last question. I doubt you will be able to manage all the questions, but if you have the names down, I mean, maybe you can go through all of them very rapidly, but if you don't, I'll give you the name of the person you were not able to answer.
Okay, thank you, Andrea, for the presentation. The same question on economic group, how you treat heterogeneous economic groups, because in climate finance, they are a topic. And what about the distinction between green, brown, and in transition companies? Because from a certain point of view, all companies are in transition. So if you can deep dive this concept.
Okay, so do I answer?
Please, go ahead.
Yes. So I'll try to be super quick. I know that you that I'm taking time from lunch. So the first question is why, when there is an increase in rates, you should charge more to polluters. Okay, so there is a theory. There are theories on the so-called risk-taking channel monetary policy. For several reasons, there are different models have different reason based on different frictions, different information friction. The idea is that when monetary policy becomes tightened, then banks lend less to riskier guys, okay, lend less to the marginal borrower, okay, and so if what I'm capturing here is risk. Is this climate risk? Like the banks will consider it a risk for them. Then the same argument should apply, no, to traditional credit risk. Okay. So for Brunella, so we use a dummy. So we use the dummy. So with the dummy, whether they disclose a reduction target or not. Now, why we do this? So there is also another variable that is, there are two other variables actually. There is a variable which says, okay, how much is this target? No, it could be minus 15%, minus 20%, minus 40%. And there is a variable that says when. Okay, so when is typically, they always say 2030. So on this, we could exploit whether, the company which declare larger or smaller, then this could be another source of information which we could exploit. The thing is that they say we want to reduce 20%, but we don't know relatively to when. Okay, so this is why these other two variables, I think they have more of these data problems than just whether they say or they don't say that they have a target. We suggest that they want to reduce targets in the future, and in fact there is evidence which show that if they say one, indeed they cut in the future. Is the paper Bocconi and Kamarsinski. So in some questions they say, okay, but companies are complex, in particular large companies are complex. So we go at the listed firm. So the listed firm, the group level, and there is these numbers of emissions, which is at the group level. Okay, so this is the what this commitment is all at the group level. This is the number that we take. So Elena, at this point on the speeches, actually we could do something similar across the speeches. So this is very nice, in particular speeches related more to climate. In fact, I have some work at the Bank of Italy where I show that when the first time that they announced the climate stress test, not so the publication, but that's the time where they announce that in the future they may consider climate stress test. Already there is the banks in Italy change their behavior in terms of prices. So the last question on firming transition. So we don't call it so firming transition comes only from this survey of the BILS or the BLS. The thing is that we don't know what the firm in transition, right? In my analysis, not firm in transitions were these targets. So the proxy is that the firm disclose a target, is going to reduce it. Now, instead, the BLS, what he did is he left it to the banks. We say, define, consider bank which is brown, consider bank which is green, consider firms that is brown, but is showing that it's going to change their policy. How are you going to treat them? So it's based on a self-evaluation done by the banks of their own borrower. Now, if I have another like 20 seconds, let me just say something that maybe will come up, maybe for this policy conversation in the afternoon. So why is not in the PD? No, I thought that maybe in the question this could come up. Why is not in the PD? So if it is clear risk, if it's a risk for you, because you are afraid that a transition, some law will pass and there will be a huge carbon tax, and this company will at some point there will be a run, someone say a run on this company. Why they don't put in the probability of default? Well, we think there are 3 reasons why they don't. There was an empirical questions, and we found that PD and these ones are priced on top of PD. But why it's not already in PD? First of all, it's an issue of horizon. Okay, PD is defined as the probability that you default in 1 year. Okay, and probably this type of risk, these are not like 1 year horizon. Second, it's not clear that these internal models, as someone mentioned in the past, can deal with these risks. These are tail risks. There is no evidence on the past. You cannot put a Z score. You cannot do a Z score on these. And third, there is a question of incentives. So unless there will be capital requirements and you're obliged to do something about it, at the moment, why put it on the PD? If you put it on the PD, you need to put more capital, right? So I think these are the 3 reasons why at the moment they're not in the probability of default. Thanks, and sorry for taking time from your lunch.
No worries. Thank you, Andrea. Thank you to all of you.
Welcome back to the afternoon session. We have now the great privilege of having Irene Monasterolo, professor at Utrecht University since recently, and also I'm proud to say fellow of Oxford, speaking on climate risk assessment and climate investment and the role of investors' expectations and policy credibility for the EU transition. Without further ado, Irene, over to you.
Thank you so much. Pleasure to be here today. Thank you for all the organizers. So today I'm trying to, with this presentation, I'm trying to build a bridge between what we discussed this morning, so starting with the scenarios, risk assessment, and why it matters, in particular when we talk about investing in the climate. So how much we need to invest, and in this regard, I will address a key challenge for investing in climate, which is climate policy credibility. Why it matters? It matters because in order to mobilize finance, we know that we need investors to believe to believe in risk, to believe in the fact that governments will make the transition. And however, in this regard, I mean, the lack of policy credibility could massively affect investors' expectations, and through that, risk assessment and capital mobilization. And we will go through the presentation with some insights on how to do that. So basically, I will talk about why assessing climate-related financial risk matters in an uncertain world. I will focus on climate stress test in particular, and providing some lessons from really rich body of research and policy practice. And then I will focus on the interplay of investors' expectations and policy credibility, why it matters for the transition and supervision. And then we will move from climate risk assessment to climate investing, and then we'll introduce a new proposal that we just published. So there's a working paper online together with colleagues, including Marco Pagano, for a European climate bond in the Euro investment gap. So the paper is co-authored by Marco Pagano, Antonio Pacelli, and Carmine Russo. Assessing climate-related financial risk. So here you can see on the left, Kristalina Georgieva, on the right, Christine Lagarde. What do they have in common? Well, they are among a growing number of financial actors, including central banks and supervisors, worried about the impact of climate risk on financial stability. And in this regard, in particular, since the Paris Agreement 2015, over 140 central banks and financial regulators joined the network of green financial system that recommended investors to conduct climate financial risk assessment and climate stress test using scenarios that the network of green financial system co-developed with the process-based integrated assessment modeling community. Why they recommended investors to assess climate-related financial risk? Well, because the more we delay the transition to a low-carbon economy, the larger the potential losses for the for the economy. So here we can start from the left. We have trajectories from the last IPCC report of GHG emissions up to 2050, and the different colors of the paths represent different scenarios. So the light blue one is the scenario, is the 1.5 degree scenario, so the most ambitious one in terms of decarbonization. The green one is the Paris Agreement aligned scenario, so linking global temperature below below 2 degrees by the end of the century. While instead on the top you see the red one, which is the trend from current policies that are being implemented. So what you can see here is the difference between the red line and the blue and the green line is that in order to stay within the 1.5 or 2 degrees target, emissions have to drop. But the way in which we get to such drop in emissions meaning for physical risk, for financial risk, in 2 dimensions. Physical risk, we have both acute risk like natural disasters, such as floods, droughts, and chronic risk, which are slowly but irreversible, like biodiversity loss, temperature increase, sea level rise. And on the other end, we have transition risk, which are risk for the economy and for the investors, which emerge from the way in which we do the transition. In particular, if we delay climate policy introduction, meaning that when we introduce the climate policies, they will be costlier, and there will be also in terms of adjustment in the economy. So the switch from high carbon to low carbon, leading to an adjustment in the asset prices. So the second picture, the second figures represents the framework for thinking about how to get to 1.5 or 2 degrees. And you have on the x-axis you have physical risk, and y-axis you have transition risk. And there are different ways, for instance, in which we can get there. So we can get in an orderly way, meaning we introduce climate policies such as a carbon tax in an early and predictable way, meaning that we will have low transition risk, but also low physical risk, because we do mitigation per time. On the opposite, we have a delayed transition, which falls into the disorderly scenario. Delayed transition means that we postpone the introduction of climate policies after 2030, for instance, in this case, meaning that when we introduce the policies, they will have to be relatively costlier, simply because we have to feel that the lost time and the lost mitigation, meaning we will have higher transition risk, but still manageable physical risk. And on the opposite, we have 2 scenarios. The one scenarios of photos board, where we just go on like with current policies, which we know will not be enough to stay within the 2 degrees target. So we will have high physical risk and get low transition risk because of the absence of ambitious policies. And on the top right, you see the fragmented world, which is a world in which governments move very differently on climate in a coordinated way. And in this scenario, we will have high transition risk and high physical risk. Different ways in which we get there mean associated with different implications in the economy. Here on the right, you see the result of a paper that we published together with colleagues, also this ECB working paper, where we look at the real GDP of the euro area in comparison, and here the results are plotted for a disorderly transition and limited physical risk, which is the yellow bar, disorderly transition and average physical risk, which is the blue bar, and total score, which is the red bar. And these results are plotted in comparison to a scenario of orderly transition, meaning we introduce a carbon tax early. And what we see here is that the more the losses, the economic losses in real GDP will be large and even over 12% in a total score scenario. So in contrast, the losses will be lower if, in the case of an orderly transition, which is the part, the positive bars you see at the beginning. So the more we weight the cost for the economy, and not only for the economy, but also for the investors. So this is the result. Here you see the results of the climate stress test to the financial system that we published in 2017 on national climate change, which was at that time the first framework that translated climate scenarios, like the ones that are now developed by the NGFS, in a stress test of individual portfolio in the financial system. So on the left, you see that investors already at that time, so these are on 2015 data, are highly exposed to activities that could become stranded in the carbon transition. These activities, we classify them into what we call the climate policy relevant sectors. So exposures were large and heterogeneous. And on the right, here you can see the potential losses on the climate value at risk for, we have a list of 20 banks, where, what you can see is that also losses could be relevant for banks that go on with a business as usual investment strategy that at that time was mostly high carbon. And the different colors of the bars, so the dark color represents first round losses, the light color first plus second round losses. So mostly what the result here, the message here is that going on with a business as usual investment strategy would lead to potential financial risk. And however, banks are differently exposed to this risk depending on their investment strategy. And also, however, the numbers could look small here, smallish, but consider at the time we were still using much more conservative scenarios and only for transition risk. So now these results will look very different. So central banks and financial authorities started to carry out climate stress tests. The first one with the European Central Bank, then OEB, Banque de France, and Bank of England. What are climate stress tests? Climate stress tests are tools that allow us to quantify the largest losses that a financial actor could face on the balance sheet, conditional to the realization of a set of climate scenarios, like for instance the one now developed by the NGFS. And in addition to the actual exposure to climate risk, the losses depend also on what we traditionally consider in finance, so leverage, indirect exposure to financial network, and the potential mispricing of collaterals associated with the contracts. Importantly, was mentioned also by Nicola this morning, climate change and scenarios are characterized by uncertainty, and policy credibility is a key driver of this uncertainty when we talk about transition risk and the potential implications then on political risk. So overall, the goal of climate stress test, and also the reason why financial supervisors are and move in that direction is twofold. On the one hand, is to have financial institutions to assess and manage risk, and on the other hand, to inform the reallocation of capital from high to lower risk sectors, so ideally from high carbon to low carbon activities. So stress test, you might be familiar with stress test. It's the last financial crisis, 2008. There was a surge in the importance of this tool to assess and manage risk. What are the differences between stress test and climate stress test? Well, mostly it's in the use of scenarios and the characteristics of climate risk. Indeed, both stress test and climate stress test aim to quantify the largest losses that the balance sheet of an individual investors on the micro potential level or the financial system at the macro potential level could occur given the realization of a set of scenarios. Usually we have a mild and more severe scenarios. Then you translate the losses conditioned to the scenarios into the adjustment in counterparty probability of default, financial performance, and the adjustment in the evaluation of financial contracts. You then estimate the distribution of losses and calculate these measures, such as expected risk or expected shortfall, to capture the tails in the loss distribution, and you can also account for financial danger. So basically, as we said, so stress tests are not new tools. They're being used by central banks and financial supervisors. But you know, in the last financial crisis, the difference here is in the type of risk that we are considering and captured by the scenarios. This is why the characteristics of climate scenarios and how to use them is fundamental. This is how kind of a climate stress test framework, the blocks of a stress test framework would look like. So you start from the scenarios and you translate scenarios into estimates in the sector's production, so output by the type of energy technologies. So you can see here on the left, you have wind-based electricity, on the right, gas-based electricity, or goes up, as we would expect in the decarbonization scenarios. And instead, the gas-based electricity output is estimated to go down in the decarbonization scenarios. Then we translate this adjustment into an adjustment in the cash flow streams of the securities and in the adjustment in the financial valuation of the contracts and securities of the firms in the sectors. And to let them, you calculate the adjustment in the financial risk metric of the investor who owns exposures to the firms, potentially considering also for reverberation in the financial net. There has been really, as we discussed also, and there will be more discussion in the panel after the talk, there has been a growing debate and applications about climate stress. So what we, and here I would really just like to focus on three key lessons that are proved to be very important in understanding what we get out of climate stress. So the first is about climate scenarios. Climate scenarios are crucial, and what we should ask ourselves is, are the scenarios capturing the breadth of physical and transition risk and the interactions, including with other type of shocks, so what Nicola talked before about compound risk, and also are they capturing the fact that investors look at these scenarios and form expectations that then affect the risk assessment and that's the transition. So that's the first point. The second point is about, okay, how are we considering, are we calculating the exposure of firms to risk and the physical transition risk? Are we considering the right metrics? And on this, there is still quite a lot of confusion, in particular still on what we can define as green, also because of the kind of challenges, still persisting challenges in the quality of first disclosure in absence of a supervisory authority that would check the quality of disclosure of first. And the third point is, okay, this information is then elaborated through macroeconomic models. So far, the major problem was that the shocks analyzed, the shock estimates from climate scenarios were really small in terms of GDP. Now there have been some developments in recent years, but still the characteristic, we should be aware that the results that we get in terms of shocks in GDP are closely connected to the characteristics and assumptions of the macroeconomic models that we use, for instance, rational expectations and representation and so on. So these are all 3 points on which there will be a lot of work to be done in the future to strengthen the climate stress test and also to allow investors to then develop their own climate stats, since, for instance, the euro area banks have already to implement them. And just to make an example of why this matters, when we talk about disclosure, are we considering the right metrics, or what are the implications of the metrics that we use to define what is green than when we want to do, for instance, the rebalancing of our portfolio, moving from lowering our exposure to brown or to high carbon and increasing it to green. Well, here is an analysis that we did on the corporate bonds portfolio of the ECB, so the purchase during the COVID period, and considering two dimensions. So on the one hand, on the y-axis, we have emission intensity, considering scope 1, 2, and 3, and on the x-axis, the ESG score from Sustainalytics. This is a joint work done with Giacomo Gressano and Stefano Battistoni. And what we saw here, look, for instance, at the right bottom figure, what we see here is a major difference in the emission intensity reported by two companies. So VW is Volkswagen, and on the bottom we have FCA, which is now Stellantis, which affect, of course, their ESG risk score. So we have a difference which is of 40 times, and this is only using GHG emissions, which is what most protocols, for instance, the Task Force on Climate Financial Disclosure recommends. Well, this result is all driven by the fact that one of the two companies doesn't report scope 3 emissions, which are crucial for the business, and does actually seems to be much lower in emissions than the other. But this, of course, is a major implication then when you want to do, for instance, the greening of your asset purchase program or of your portfolio, because then you will go towards, you will rebalance your portfolio of corporate bonds towards Stellantis and not Volkswagen. But in reality, you would have not really green your portfolio, since all the difference is driven by the quality of disclosure. This is just one of the examples that we could make. So we say another limitation of climate stress so far is that they don't consider scenarios, don't consider the role of finance and investors' expectations. But this actually is very important. And now I would like to talk about the interplay of expectations and policy credibility on making or failing the transition. So if I have to convince you that there are some troubles with the climate policy credibility, and there are some recent examples. So on the left, we have Trump withdrawing from the Paris Agreement in 2017. But here on the right, we have two more recent EU examples from the European Union. There was an article on, they're both from Politico. So in December last year, there was an article discussing the possibility to withdraw some part of the money from the Green Deal to reallocate it to other priorities. And more recently, this is just from yesterday in Davos, actually, there was Ursula von der Leyen actually mother promises on green technology investments. Why this interplay between investors' expectations and policy credibility is important? Because we know that investors take investment decisions based on risk assessment. And expectations in this regard matter. In particular, when we talk about climate, here we talk about also climate policy announcements, which come from governments, from central banks, and so on. And in this context, what we called a few years ago the concept of climate sentiments, so right, the fact that investors form expectations based on policy announcements, and through that they adjust, they consider this as new information to adjust the risk assessment and thus the cost of capital. So if they believe that the governments will introduce climate policies, they will adjust the risk weights, increasing them for high carbon companies and decreasing them for low carbon companies. And this in turn will affect first investment decision in the transition, and through that the transition scenarios and our ability to stay within these scenarios and these transition paths that we saw here on the left. But on the other hand, if investors look at the current situation where, let's say, policy credibility is somehow challenged, then they might decide not to adjust the risk assessment, so not to consider, not to take climate risk into account. And this has some major implications. And the implications can be here. So this is an analysis that we did and we published 2 years ago 3 years ago now in Science. So we considered what would be the implications of investors having climate sentiments and trusting an ordered introduction of climate policy, which is the immediate climate policies, or and in that case, investors will enable the transition, or the opposite, if the investors don't trust climate policy and in that case would hamper the transition. So let's focus on the bottom right panel. So here we have on the left the results in terms of energy output, and on the right asset valuation adjustment. What is the red line? The red line is the signals the introduction of a carbon tax. It's a 2030 because it's coherent with a delayed climate policy scenario. So introduction of a climate policy after 2030. The straight lines are the output trajectories from the NGFS scenarios using only process-based integrated assessment models. The dotted lines are the same trajectories that take into account investors' expectations and translated into climate risk assessment. So they include the results of climate success and an adjustment in the cost of capital based on that. So what we see here is that in a situation in which policies are delayed, which is mostly the scenario towards which we are heading, and investors don't trust them, then there will be a later and more abrupt adjustment in the output, both of renewables, which is the green one, the green part, and fossil fuels, which is the brown part. And this later and more abrupt adjustment in output will then lead to a more an abrupt adjustment in the valuation of the assets for the company. So in this case, actually, the transition will be really disorderly and it could bring implications for price stability. So having discussed, yeah. Okay. So, and now we say, okay, this all matters. Why we care so much about the policy credibility and down the affect investors' expectations? Because we have a green investment gap. So we need to mobilize much more money, we need to fund money. And as we said before, investors decide how to allocate money based on risk assessment. So here in a new paper, we looked at how much money we would need in Europe for mitigation and adaptation, and we propose a new solution to fill the gap in a context in which we are considering stricter fiscal rules. We have the new fiscal compact in place and potential, as we said before, diversion of green money to other priorities like defense and so on. So first of all, in this paper, we try to estimate what is the green investment gap in Europe, because we were quite surprised when we started that there was no clear estimate. So on the one hand, we have the budget for the current programming period plus Next Generation EU, where the European Commission placed 2 trillion euros at current prices, and which means about 330 billion per year allocated on mostly mitigation. But in addition, we have also adaptation expenses with adaptation needs, which are in the difference from mitigation, they are much more unclear. So it's still not clear how much we should invest in adaptation, which priorities, and in particular in which country. You know, the countries are differently exposed to natural disasters and have different level of resilience. But overall, the overall investment needs, based on the literature,
range between 550 billion per year and 912 billion per year. So this is all based on the literature, including also IPCC report. In the European Union, then, the EU investment gap for 2023 is given by the needs, which are overall 700 billions, minus the money which has been budgeted by the Commission, which is 330 billion per year, so reaching like 370 billion per year. If we consider a lower bound on adaptation needs, so if we consider an upper bound of the 912 billion per year, the gap will rise. However, we should consider also that calculation could be we don't need relevant mitigation and adaptation expenses, so we have uncertainty, climate impacts, and a part could be covered by national member states. But however, in this regard, we should see that more recently from the OECD showed that countries were not so able to spend the money and cover this cost, so we will have still 1/4 of shortfall in the need. And the need. How to close this gap? So in this paper, we propose the issuance of a European climate bond, which would connect EU fiscal policy for climate, coordinated with joint financing. The proposal is based on strengthening the current carbon pricing framework in the European Union by extending the ETS to all sectors. The European Commission is already moving in that direction, but we put it really to all sectors. And the European Commission to manage the supply of the allowances and the revenues and consistently with a science-based price target of carbon, which comes from the NGFS scenarios. We also propose the bond to be issued by the European Stability Mechanism with the interest and capital, which is serviced by the ETS revenues and guaranteed by the currently unused ESM resources. The cost of servicing would benefit from the rating of the ESM, the green nature of the bond, which would be appealing to investors who need to green their portfolio, and the sovereign nature of the bond, which will lead to a favorable treatment by prudential regulation of banks and insurance companies' exposure. Proposal is quite timely. So this is just from yesterday. Yesterday at Davos, Macron called for a joint European debt to invest in the future. We're including among the priorities also green. And on the other hand, Mario Draghi, a few months ago, the Economist called for a joint fiscal policy in Europe to address the key priorities, including the transition. Why a common design and funding of climate in Europe? Well, let's start from the design. Why climate policy should be designed at the EU level? Well, because national standards will lead to an inefficient climate policy target. Indeed, on the one hand, EU member states will have individually less incentives to account for the cross-border externalities of not doing mitigation in their country, and so insufficient spending on mitigation. Then, on the other hand, we will have the issue of carbon leakage. So countries which have milder regulation would attract more high carbon activities and investments, so leading to regulatory arbitrage. And then also the last point we should not forget is that some countries in Europe have the possibility to spend, I don't know, have very limited or no fiscal space, and this will hinder climate investments with negative implications not only for the country, but since we are in a common market, for also our neighbors and trading partners in the European market. So the supranational design would also limit the capture of national authorities by national pressure groups, and thus a EU-level design is efficient not only to fund the gap, but also to design climate investment program. On the other hand, we also believe that joint issuance would be more efficient because the shortfall is initially larger as the efficiency requires climate investments to be front-loaded. And so the earlier we invest, the less expensive it is. And for this, we need public debt issuance. because fiscal capacity is so far insufficient, and we could expect to be even more insufficient after the new fiscal rules. And this would lead countries, in particular weaker from a fiscal and financial point of view countries, but not less exposed to climate risk, to underinvest. And this outcome will be, so underinvestment will be actually inefficient for the whole EU because of climate spillovers, economic spillovers, and potential sovereign climate crisis. Just a comparison with some human as okay, but we already have a climate bond like the one issue, we have already, sorry, a common bond like the one issued under Next Generation EU. Well, the bond that we propose are different features that would allow to overcome some of the limitation of the Next Generation EU issuance. So we will have a regular issuance, so there will be that rollover. It will be issued in high volume and so high liquidity. It will be backed by the ETS revenues, and thus it will be sovereign and safe asset. It will only target climate policy investments and thus potentially leading to a green, and it will be placed by via options, so with low issuance costs. How many climate bonds should be issued in Europe in order to fill the gap? Well, in order to address this question, actually we use the NGFS scenario, so we use the trajectories of emissions and carbon prices in order to calculate the revenues that we will get across 4 of the NGFS scenarios. So we consider below 2 degrees, delayed transition, fragmented world, and current policies. We assess the EU carbon fiscal capacity in 5 steps. So first, we take the NGFS trajectories for carbon prices and emissions, which are calculated every 5 years and then every 10 years after 2050. Until the end of the century, we turn emissions from megatons to tons. We convert the revenues in 2023 US dollars using GDP deflation, and we interpolate yearly because the NGFS scenarios, the time step is 5 years. And then we compute the present discount value, so starting from 2024, discounting over 76 years. And then we convert the present discount value using the current exchange rate between euro and dollar. And here is what we get. What you see, the red line that you see here, actually, is the European Commission long-term budgets over 6 years, which is 2 trillion. And all the revenues that we get here as a result are larger than this budget. And in some cases, in considering even in the condition, in the scenario of a fragmented world, which is very similar to what we are actually seeing now, it will be even over 11 trillion. So actually, the fiscal capacity that we will get from extending ETS and getting the revenues will be very large. What are the benefits of this proposal? So on the one hand, it will allow us to address the need and request from the market for a safe and green EU asset, and in this case, it will support them. We have some benefits for financial stability, so avoiding the loop between banks of the risk, and avoiding certain capital flights in case of risk on those countries. And there will be some benefits, liquidity benefits, because it will be a regular issuance and in different maturities. Then there will be some macroeconomic benefits. And here in the feedback loop that we present, we show how the more we invest in climate, the more we will countries can build resilience to climate disaster, and the more this will strengthen economic growth and fiscal capacity, which in turn will provide the money to the governments to keep on investing in climate. But on the other hand, it will also strengthen investors' expectations about the country's ability to withstand climate risk and thus lowering the sovereign yields, which will allow the countries to access cheaper financing for climate going to the market. Yeah. I'm finishing now. This is the last slide. There will be also some, and this is the last point. So the benefits will also for greening investors' portfolios and monetary policy of the ECB. Because this bond comes with a conditionality on what is green. So the use of revenues from the sale of EU bonds are conditional on their use to fund climate projects in the EU. So the implementation will be monitored to key performance indicators about the implementation of projects at the national level. And these key performance indicators will be monitored by the European Investment Bank, who is already doing so for structural funds, cohesion funds, and also for the recovery resilience facility. And of course, there are some penalties. So, EU member states that fail to deliver will face a penalty, which comes from reduced allocation in the subsequent funding. And thus, the bonds will likely to command a premium relatively to a comparable safe sovereign asset, such as the US Treasury. And this new green product, actually green and safe product, could be used by the ECB as a collateral to perform monetary policy operation and as a tool for asset purchase program. So overall, in my conclusion, that doing climate financial risk assessment and climate stress test is important, the way we do it even more, and because this would have implications then on how and if investors reallocate capital, and thus also can support the transition. Scenarios are first step to improve, and in particular, they should include the interplay of investors' expectations and policy credibility, because they can shape the transition path and the financial risk associated. And moving towards from climate risk assessment to climate investing, the proposal for EU climate bond could narrow the EU investment gap by supporting green fiscal policy in coordination with financial policy, providing a safe green asset that investors can. Thank you so much.
Thank you very much, Lorena. We now have our question.
Very much question on how the value the value of investments scenario, and how do you account for the fact that what the EU does will not change the path of emissions at the global level. If you account for 10% of the emission. So how are the two related to different scenarios which impact the different classes of parts of the world? Usually two manages but also, yeah.
Yeah, so let's start from the second one.
Yes, please go ahead.
So let's start from the second one. So the revenues come from the service of the ETS allowances on the market, which would be extended to all sectors. So the proposal is first to extend the ETS to all sectors over the most of the issues.
Are there further questions?
That's the official argument is that the European bond is consistent with the idea that this is a union level project. That was born also historically at the level of the union. Yeah, and I think this is additional consideration of people take.
No, thank you so much. We will, we have just published the working paper online, but we will for sure, I mean, this is very useful to strengthen it. So we were looking just at the more direct benefits on the macro and the financial side, but also this point is absolutely relevant.
Nick, I had a question.
Thank you for the presentation. So on the Eurobond, can you tell me the reasons why it wouldn't work in practice?
Why it wouldn't work in practice?
It seems too good to be true, so why hasn't it happened already? And I also wondered if you mentioned the sort of the politics and yeah, have you thought about how you would allocate the funding and questions like how you would ensure it would crowd out the private sector, for example?
Okay, so to good to be true, I mean, we have to discuss. However, we found that when we talk about okay, why the current next generation EU bond will not be enough, well, there were some issues related to the way in which it was designed and issued, which is also somehow linked to the way in which, for instance, the ESM now issues bond, and in which the ESM has a quite high ESM bonds and quite higher yield in comparison to most EU the yields of most EU countries like France and Spain. And this is due to the way in which the bond was designed. So this is we try to address some of these issues in the design of the EU climate bond. And maybe I would not say that it's perfect, but at least by addressing some of the issues in the joint issuance of bonds, maybe it could perform better. And the other point is, how the revenues will be allocated, how the money of the bond will be allocated to countries. Well, this will be based mostly on a criteria of efficiency. So where there is marginal, where let's say one euro more will lead to a higher marginal productivity of the money, because the country is much more in need and has lower fiscal capacity to fill the need. So most of the countries which are already suffering the most from disasters, and also play an important role in let's say in the EU value chain. So if a country blocks, then so the others then will be negatively affected. So the idea was mostly because of the efficiency in the use of the money. So not on the GDP level or some other criteria for this. And the last question was on crowding out the private sector. On crowding out the private sector, well, actually, the idea would be right the opposite, because these projects should be implemented by someone, and this someone is not only the public. If you think about big infrastructure, so big have also a public role, but also you have also private sector contributing to the project. So the idea would be really the opposite, to get investors in, both in the economy, but also in finance, to include this product in their portfolios.
Final possibility for questions? Yes, please.
perspective, I think that this may be a way to move money to government that can affect finance adaptation. That is a local problem that can be delivered by infrastructure that needs to have public support. Because as an investor, I see that it's easier at this moment to invest in mitigation through investing in companies to finance the transition and the reduction in emission, while investing in adaptation is less easy because it's more local. So I think that this passing of money through the government with a view of how the adaptation may be delivered through different country may be very useful to collect money and deliver it when it needs the most.
Yeah, our idea was started really from financing adaptation, because it's also it's very different in terms of type of investments from mitigation. For adaptation, you usually have larger investments with which involve also public goods. So that was indeed the idea.
I have a final technical question, if I may, regarding the discount rate again. Is it reasonable to apply the same discount rate to the various scenarios? Because those various scenarios imply very different states of the world. So that might also affect the natural rate. It would, of course, also affect risk premiums. Now, I don't know whether you should have risk premiums in the discount rate, but at least to me, this is an issue.
That's indeed a thing on which we are working. So the point is that we didn't really know, I mean, what different discount rate to apply. And on this, I think it would be very important to have a discussion, because so far we just took what was in the GFS scenarios, and but that's for sure. Thank you. That's a very interesting point.
Donato?
Flash question. Which is the political sentiment? You know, sorry for my bias.
Political sentiment.
No, okay, but
Yesterday,
okay, this is sorry, Irene, but these are really general, club.
They're not for no, ma non credo si può fare.
Okay, Irene, I just.
No, don't trust me, okay, but it should not help me, okay, that's what I wrote. No, the political sentiment is just.
Club traps.
One, two.
So my curiosity, I'm completely ignorant. If there are.
The first time I presented, so that's amazing.
No, if you heard some scientific one.
No, done, okay, but that's maybe. Thank you.
And if you can give you a different flavor of the sentiment, and since Dani goes from the end, and since Nicola asked why it might not work. Now, the first point is that the president is EU bonds at a much higher yield than most non-EU countries.
Yes, but for these reasons.
There's no, of course, in a way where it's lower, more, and when there was more, the also. This is an ex post classification, right? There's no guarantee that these newer bonds, even with the allowed frankly to be available, will have lower yield. And the term bonds, Indians here, it's very difficult to replicate. So if that persists, it's likely, then of course, already very large part of the youth would not be interested in taking. And therefore, there would be an implicit subsidy from stronger rated countries towards ESM, which then has a portfolio consisting only of the weaker countries, bigger big ones. That's the first thing that occurs. Second point is so simple. Money is 100.
Money is
100. So if you country the credit, right, at cheaper rates, let's say space than would otherwise pay on the market. That enlarges its fiscal space. For what will this fiscal space be used? We have seen it with the NGO money. It will be used according to the ability borrowing of the country and not necessarily one-to-one. This money goes into green investment.
But may I say something, because these are really the points which we were discussing here on why this should work differently.
This would be a ESM loan to a country separate.
No, that's the ESM issues it. So sorry, I mean, I think that there is a misunderstanding. So there is, the ESM issued only the bonds, but the bonds are serviced by the revenues coming from the ETS.
And I understand.
Yeah.
ESM uses its money to give a credit to someone.
Gives it to countries, but the countries are the money is only used for green projects and they come with a conditionality.
Yes, but then the countries, as we have seen with the NGO, they just do fewer green projects on their own account and have more money to spend on other stuff.
I know, and then they will get the money, they will have to get the money back and they from the next issuance. So that's the point. That's also the conditionality that included. I completely understand, and that is a big problem that of the current bond, because otherwise it will not.
Sorry for my telegraph request.
Excellent. Thank you for allowing me to clarify. So the main difference is really comes with the conditionality. So this is only for financing green investments, which come with KPIs. If the country doesn't deliver, then doesn't get money anymore. That's the problem. And then the other point of countries have already money. Well, the investment need is much higher than what countries get now in terms of money. So where do they find the money they need? It's a bit challenging.
Okay, I think this last round showed that there are still many open questions, and that's this very interesting and promising idea will not be controversial in the political arena, and there are many also economic arguments pro and con. So thanks for taking this initiative. I think it is now time to thank Irene. Also for jumping in at very late notice, I must say, because of some difficulties that we had in getting agreement from a speaker. So thanks really very much for that. And we now turn to the last part of the conference, to a panel session. Please, could I ask the panelists to join me here at this table? No. How do we do with this microphone? I think we just use this single microphone, which is a long enough line, so we can just switch it between the speakers. So our final policy panel is going to deal the topic addressing climate risks in financial firms, gaps and way forward. So in a way, it builds upon the things that have been discussed so far today. We have a formidable panel of experts with us. I start with a lady to my right, Lucia Alessi, who many of you know. Lucia is from the European Commission, from the DG Joint Research Center, close to Milano, I understand, at Lago Maggiore, very enviable. Lucia's team develops research in the field of finance with a focus on sustainable finance and digital finance, including the assessment of the greenness of financial portfolios, as well as physical and transition risk. So you are ideally suited to be here with us today. Second, to my left, we have Livio Straka. Livio is Deputy Director General, Macroprudential Policy and Financial Stability at the European Central Bank. Livio has widely published on macroeconomics, monetary and financial economics, and international economics. More recently, you have more focused on climate change and green finance, and you represent also the ECB in all the relevant fora globally. Benoit, bonjour, old friend of mine, colleague from the ECB, the Banque de France. Benoit has been the head of economic analysis at the Bank for International Settlements for over 5 years now. Benoit has widely published and worked on macroeconomics, monetary policy, financial topics, and now also more recently on green finance. And finally, online with us today is Chris Faint. Chris, can you hear us?
I can. Good afternoon.
Perfect. We can hear you as well. Chris is head of the Climate Hub Division of the Bank of England. And he's also closely involved in the work of the NGFS that has been mentioned several times before. Chris has responsibility for developing and implementing the Bank of England's strategic approach to climate change across all the Bank of England's policy operations. This is a huge remit. I wonder how you can manage such a huge project. Now, we will open the session with brief introductory presentations by all the 4 panelists, and then enter into questions and answers. I'll start this Q&A session with the first round of follow-up questions, and warmly invite you all in this room and online to join the discussion. So without further ado, Lucia, may I hand over to you?
Thank you, Ernest. Thank you very much for the introduction, and many thanks to the organizers for having me. So indeed, as you can see from the slide, I would like to talk about climate stress testing. I'm afraid I'm going to make some enemies based on the talks that we had earlier, but it would be boring if we would all agree on it. Okay, so let me move on. Does this work? We should move to the other. It should be. Maybe it should be. All right. So in this slide, you see a schematic overview of the main types of financial models that are in the toolbox of policymakers to monitor and manage climate risks. The first type of models coming to the scene are scenarios, essentially. So, for example, the NGFS scenarios. The ones that are available so far are long-term scenarios, so around 30 years. And these are very useful tools to structure thought on the implications of policy-induced emission pathways, to structure expectations, and they are very relevant from a scientific perspective. They have some limitations. Some Nicola already mentioned that the underlying climate scenarios underestimate the probability of tail events, that compound risks are not addressed properly yet. It will take some years before climatologists get to that point. But I would like to focus on an important limitation, in my view, from a purely financial perspective, which is that in the industry, in finance, no one really cares what happens in 30 years. So these models have limited impact on the industry. And if they have limited impact on the industry, they also have limited relevance from a policy perspective. So the point is that if we need to raise awareness about the materiality of climate risks, which I'm not saying they're not material, they are material, but we should look more to the shorter term. And I'll get to that a bit later. The second class of models, we could call them efficacy or feasibility assessments. They have a medium-term focus and aim at investigating whether there are bottlenecks or impediments that would prevent a sufficient amount of money to flow into green or greener activities. Now, of course, this is a legitimate question. For example, whether households might be financially constrained and are not able to, change their car to an electric vehicle or improve the energy efficiency of their building, or if there are macro-critical factors related to climate, for example, if there could be impacts on sovereigns. So these are all relevant questions. However, looking at the financial system in particular, one of the questions that I hear being asked is whether the financial system would be actually able to finance the green transition. Is that a feeling? All right. And I would argue that this is a non-issue. Already back in 2019 with Stefano Battistano, we did some quick back of the envelope calculations on how much money we would need to finance the EU climate targets. And just to give you an example, the green bond market would need to go from around 1%, where it is now, to about 10%. 10% is perfectly within reach. So the message here is that the money is there. It's not like we don't have the money. We just need to redirect the money in the right direction. And here we come to the third type of models, which is climate stress testing, which I would argue is the key type of model for policy, because climate stress testing, because of its short-term focus, is able to create the right incentive structures for financial institutions to actually actively manage climate risks. And the second reason is that climate stress testing allows, in principle, for consequential policy action. I'm thinking of prudential policy, be it micro or macro prudential. Essentially, you cannot ask a bank today to raise capital to protect itself from risks that will materialize in 30 years, okay? And also, you cannot assume that the balance sheet of the bank will be the same in 30 years. So the only horizon that is really actionable is the short term. However, there are some challenges with climate stress testing models, which one needs to be aware for two main reasons. The first one is that these models need to address the right risks. Otherwise, they're not good models for what they are for. And the second reason is that they need to convey the right messages, because these models are used by policy institutions and the underlying narrative is very important. So these are not only things that stay in the academy. Now, the first challenge, very quickly, has to do with the time frame. So climate stress testing is inherently very difficult because it aims at detecting short-term vulnerabilities to long-term processes. The transition will last decades. Natural disasters will become more frequent, but the sea level will not rise next year. So let's focus, for example, on transition risk. What I would like to argue is that because of this discrepancy between the horizon of the model and the horizon of the shock, if you want, which is not really a shock because it's a process, it's a transition, we cannot really use off-the-shelf climate stress testing models, but we really need to develop a new class of stress testing models precisely for climate-related shocks. And let me explain what I mean. So, sorry. What I did. Just 1 second. Because this is, all right. So what I mean is that in classical, traditional stress test models, there is a stressed macroeconomic scenario. There is a recession, a negative shock to GDP. And then what we do is we look at the impacts on the financial system. When it comes to climate, you cannot assume that the stress originates in the real economy. This is really a no. Why? Because there is no policymaker on earth that will ever implement a climate policy that jeopardizes the economic system. And if you look at any piece of regulation, any policy strategy, they are always based on very careful impact assessments. They are always phased in a very gradual manner. Some actually argue too gradual. So, of course, there will be some economic activities that will need to be abandoned. Some companies will be in trouble if they do not engage in the transition, but there is nothing that you would see at the aggregate level. If anything, we speak of green growth, we don't speak of green recession, okay? So assuming that there could be any negative shock to GDP because of climate policy is not realistic and is also not acceptable. And now let me move quickly to the second challenge, which is related to what I just said. and which is the need for extremely granular data. As I said, owing to the green transition, there will be losers, but there will also be winners. And they can be in the same sectors, like take the example, the very obvious example of the energy sector. Renewables and maybe nuclear will replace fossil fuels, and this is within the same energy sector. So, but it's also important to think that even in economic sectors that are characterized by high CO2 emissions, there will be winners. Think of, for example, the manufacturing of steel and cement. We will still need steel and cement in 2050. So of course, these activities will need to stay. And those that will be better able to transition to implement better production processes will be the winners. So it doesn't really make sense to model particular sectors as, you know, bad to invest in, risky, doomed. Because with the exception of very particular sectors, very small subsectors, this is generally not the case. And this would also send a very bad message from a policy perspective, because in fact, what we desperately need is to finance the transition of the companies that are active in these sectors, not to, you know, just cut credit lines and abandon these companies to their future. Okay, so I will stop here. Thank you very much.
Thank you very much, Lucia. We now turn to Livio. Yes, please. Silvia, we need Livia's presentation.
Okay, so first of all, thanks so much for inviting me to this very useful event, very informative. I learned a lot of it today. So here I want to say a few words about climate scenarios for the short run, because, you know, perhaps not or measure very briefly that now I'm leading the work on the climate scenarios, and I'm very engaged in these questions now. And also from an operational point of view, so I need to deliver these scenarios, and we have to update these scenarios every year. It's a big operational effort. So first, one first I want to mention is that I mean a lot of these discussions saying that you know the climate crisis is a long term, and I know it's something that we have to look at the end of the century and so on. You know, it may be true for the physical side, but on the transition side, certainly not. I mean, these bar charts show you the degree of change that is expected in our scenarios, also in the European Commission Fit for 55 legislation, which is actually binding legislation. So for example, just to pick one number, so you see that, for example, in Germany. So right now, the energy production is over 70% coming from fossil sources, and by 2030, which is, you know, in 6 years from now, so this is going to be 30%. So Germany, for example, will go from 70% to 30% in 9 years. So Italy is now is above 70%, and it goes to below 50% by 2030. So, and this is, you know, the same for almost all countries. So what I'm saying here is that, you know, at least the transition, you know, if we believe in the policies, in the current policies, at least in the EU, is something that is happening very quickly. So it's not, it's a short-term concern, it's not a long-term question. So here, so I've been motivated by this idea that we need to think of climate in the short term. And this is also connected to what Lucia was saying before. So nobody's really energized and motivated by something that happened in the end of the century. I mean, everybody in this room will be dead by the end of the century. And, I don't think, I'm not overly pessimistic in saying that. I guess, you know, it's, maybe some of the younger person, you know, have a chance, but I don't have a chance. And the politicians don't have a chance. So which is most important.
so the question is how to bring these considerations to the present, more to the present. And this is what we are trying to do with this new strand of work in the NGFS, focus on the short-term scenario. So the question is, what can happen to climate, climate ready in the short term that actually matters right now? And so we have these 5 scenarios, which we published a note recently on these 5 scenarios. And here I want to a bit to illustrate quickly, what could happen, how these short-term scenarios can be useful to think about climate in the short term. So one of these scenarios, which I picked just one randomly, is called the green bubble. So here, what happens is that there is a boom if you want, there is an unsustainable boom in green investment. So there is a glut of green investment, and this is supported by public subsidies and other fiscal measures. And this kind of brings an accelerated transition to the Paris Agreement, with a lot of imbalances. Okay, so there is a kind of a rush towards the green. And at the beginning, you have high inflation, you have high credit growth. I mean, it was measured by others, the financing needs are very large and so on. And then this, after this bubble is created, then there is a bust of the bubble. So there are defaults in the private sector, there is increased risk premium and risk aversion. And so the financial sector and the real economy take a big hit. So this is, one of these. So this gives a bit of an example of, what kind of story can be built around these climate scenarios for the short term. And here, okay, so I will not go through all these details. By the way, I always ask my colleagues to prepare simple slides. I never succeed. So the more I insist, the more complicated they do the slides. So I failed also here. But essentially, so take this slide to mention that essentially you need a lot of pieces to run a climate stress test around the scenario green bubble that I just described. So you need granular data on climate finance. You need a source of shocks, macro shocks that come from this scenario. And you need models. You need climate stress test models. You need to map the probability of defaults of companies and households to the scenario. And you need to make an assumption about government and central banks, what they do. And this is an important part which is often forgotten in climate stress tests. So the authorities, as was mentioned today, do not sit idle. So they will react to shocks. So we saw it with COVID and so on. So all these aspects need to be considered. So it's extremely technically complex to run this climate stress test, but this is also crucial if you want to have a serious discussion about climate, because as I said, what happens, in later decades, it does not really matter for most actors, and Lucia said the same before. So here, I just wanted to say quickly a couple of words on monetary policy. Perhaps comes later in the discussion. So there is a nice paper by Marco Del Negro and co-authors at the Fed who show that the green transition may be inflationary. It does not need to be inflationary, but may be inflationary. So one parameter that drives this kind of inflationary nature is the share of sticky prices in the dirty and green sectors. So if you believe that there is a big difference in price stickiness between these two sectors, then the the transition may be more inflationary. So this may create a policy draw. There are also other papers saying that essentially climate policies are a negative supply shock. So it's a shock which basically drives inflation up and output down, and so central banks have to kind of react to this. And we know that, of course, negative supply shocks are not pleasant for central banks. So there is a positive question of how likely is it? So how can we track the green transition in real time and check whether this narrative is correct? So whether really the green transition is a negative supply shock, is inflationary, and so on. And these scenarios, the kind of scenarios that I just mentioned, may help us to give us a bit of a set of variables to look at, or a set of predictions to track ex post. And then there is also the normative question. So should central banks cooperate with climate policy? So this is an argument that one sometimes hear that central banks, so suppose that the green transition leads to large changes in relative prices and this inflation in the short term. kill this inflation is also counterproductive, because then it prevents this big shift in relative prices that we need for the green transition. So there may be a conflict between the climate policy maker and the central bank. And so should the central bank and the climate policy maker cooperate? For example, the central bank could be slower in bringing inflation back on target to allow time for the green transition to operate. And so this is an interesting question, but I would argue that under current central bank mandates, this would not be possible. So the central banks, so this kind of cooperation game between the central bank and the government would not be possible under the legal mandates. But the central bank can support, of course, in other ways that we discussed today how this can be done and what the limits are for that. So I just wanted to mention that this short-term scenario is also important for not only for supervision and climate sensitive, but also for monetary policy. So I'm happy to discuss further.
Thank you, Livio. Now we turn over to Benoit Moujon from the BIS.
Yes, thank you. Thank you very much for inviting me to this panel. It's a great pleasure to be here, to be with friends that, we were sitting in universities together with Elena. I don't want to say how many decades ago. You don't need to say how many decades ago. But also from our colleagues from the Eurosystem and even actually friends from the next generation who are in the room today. So that's really a great honor and a great pleasure. So I want to focus on one aspect of the transition of the financial system, which I think is really critical, and try to illustrate it for different asset classes. But before I do, I want to stress that what I'm going to say are my views and not necessarily the views of the BIS. So what I want to focus on is that basically there are plenty of green assets out there, provided that you think of green assets and you have the perspective of green assets in a dynamic perspective. Okay, so indeed, I mean, Lucia said it earlier. If you look at green bonds, green bonds are expanding very fast. The growth rate of green bonds is very fast, but it's still 2 trillion. So in terms of the stock market cap or the total capitalization of bonds out there, is still of the order of 1 or 2%. So it's still very small. So there you may think, okay, so investors who want to fund the transition or to reduce their exposure to carbon risk, there's very few assets they can turn to. But effectively, if you think of a green asset as actually a portfolio which is on a net zero trajectory, and there I think I'm echoing in part what Lucia was stressing earlier. Actually, a green asset is almost identical to the total stock market or to the total portfolio of the economy. It's just adjusted for a few percentage of the market cap. So let me try to illustrate this first with a work that we've done, and so this what I present is elaborated on in BIS working papers, and if you Google decarbonizing and BIS, you would find those papers. So basically, this is a histogram of carbon emissions looking at the MSCI Global Index. So this is looking at a portfolio of all the stocks out there that you can buy on a global scale. And what is very clear here is that this distribution is very highly skewed. Okay, and actually a small proportion of super brown firms, the firms which are in those sectors, the usual suspects, energy, cement, extraction, utilities, they extract they have a level of carbon emissions which is orders of magnitude higher than the average of the firms out there. And that's true whether you look at scope 1 to scope 3 emission or scope 1 to scope 2 emissions. It's kind of the same ordering of those firms. So basically, a rule of thumb is that if you look at 1% of the worst emitters, okay, if you would remove their emissions altogether and look at what you have, the 99% which is left in your portfolio, the carbon emission of this portfolio is 10% lower than the total. And actually, it's a bit more for the top 1%. But if you would carry on this process for several years, actually, what you can do within 10 years is to get a portfolio of stocks whose carbon emissions are an order of magnitude smaller than the one of the total portfolio, because you focus on most of your portfolio, which is actually much greener than what you have in the tail of the distribution. And so effectively, 95%, between 95% and 99% of your stock market market cap, okay, it's almost the same as 100% of your market cap. So if you would basically remove those worst emitters, or if you get those worst emitters to reduce their emissions substantially, okay, you would get a market portfolio which is on a net zero trajectory. That is a portfolio whose emissions are declining very substantially. 10 years the first year, another 10 years the second year, another 10% the third year. So basically, cumulatively, after 10 years, and that's simulations we did with historical data, after 10 years, you get a portfolio which is 95% of the benchmark portfolio, but it has much less emissions than the starting point, because the global portfolio has declined in emission, and because you focus, I mean, basically you have this best-in-class approach where you remove the worst emitters from your portfolio. So that works if you with corporates. Okay, so this is something we did for stocks. We did it for corporate bonds as well. There as well, it works to get this net zero trajectory. Let's move to sovereigns. Okay, so there are much fewer sovereigns. What we did here, we were using like several thousand firms for which you can buy their stocks in different regions of the world. If I focus instead of sovereigns, here I take one criteria. It's related to emission. It's basically consumption-based per capita carbon emissions for various countries. For two dates in 2015 and 2020. And on the left, you have advanced economies. So yeah, that's on your left, yes. And on your right, you have emerging markets. So there you see that, you know, Belgium, the Netherlands, and the US, they do very badly. Okay, that's where carbon emissions per capita are super high. But actually, France, Italy, Spain, and the UK, it's way better. It's almost, it's less than half, okay? It's of the order of 8 tons per annum per capita versus near 20 or above 20 for the other countries. So if I have a portfolio of sovereigns, I want this portfolio of sovereigns to be on a net zero trajectory. I just reduce my exposure to the US and I increase my exposure to Southern Europe. And you can do the math in your head simply. The same principle, I can be on this net zero trajectory. Actually, the portfolios that you obtain by increasing the weight of Italy and reducing the weight of the US actually has almost the same financial performance. It's very close in terms of financial performance to the total market portfolio of sovereigns, which was also the case actually for corporate stocks or corporate bonds. In terms of financial performance, you get the same. And what is even more important, again, emphasizing one of the points of Lucia, is that you can do that by keeping the same sectoral and geographical composition. So it's not about cutting the finance of electricity production in India. It's about investing in electricity production in India in the greener producers away from the worst producers of electricity in India. And this type of result that I'm mentioning here, you can be on this net zero trajectory by a small recomposition of your portfolio, but keeping the same sectoral structure. You don't need to reduce your exposure to given sectors or given regions to obtain this reduction to be on this net zero trajectory. Final point, final illustration. So here, what we did is that we collected data on the loan portfolio by country. Okay, so that's what banks are doing. And basically, the bars, they show by how much you would reduce the carbon emissions of this loan portfolio if you would exclude the 1% worse firms that those countries, that those banking systems are lending to. And you see that, for instance, for Indonesia or Korea or South Africa, to the right of this panel, that the reduction would be very substantial. And again, another point that several that came up today, several of us pointed to it. The maturity of loans is typically 5 years. Okay, and here we are talking about the effect of changing the loan, 1% of the loan portfolio. Well, every year with a 5-year maturity, you would anyway reallocate 20% of credit. You would roll over 20% of credit. Okay, so let me conclude here. So for these main asset classes, stocks or corporate bonds, sovereign bonds, loans, we can have this reallocation of capital. It's all about reducing the carbon emissions of the worst emitters, which is a small part of the capital stock, and this should be within reach. Thank you very much.
Thank you very much, Benoit. May I now lead over to Chris? Chris, you will share yourself. Is that the case? Or Dragana will do it for you? Okay. So Chris,
Great.
go ahead.
Can I check whether you can hear me? Can you hear me, Ernest?
Yes, we can.
You can. Fantastic. Well, first, everyone, thanks so much for inviting me here today. Sorry I can't be there in person. As Ernest said, I'm head of the Climate Hub division at the Bank of England. And what I thought I'd focus my 6 minutes or so on is how we as the Bank of England as a regulator and I guess, an observer and guardian of financial stability think about climate risks in financial firms. And what I can do is talk about some of the gaps that we observe and some of the actions that we are taking to address those gaps over time. Just going back one step, I think it's important to note that we have a remit to help facilitate micro-prudential stability in the firms that we regulate. So that's the banks and the insurers that we regulate, but also a broader financial stability remit. So as we look at the system, we're interested in not just the banks and the insurers that we regulate, but also interested in how financial risks from climate change are being embedded in other firms like asset managers, like pension funds. And I think it's fair to say that we've done a huge amount of work on this, and not just us, all central banks have done, most central banks have done a huge amount of work on this. On the next slide, I'm not going to go through all of the reports and analysis that's been put out by us over the years, but I think just a quick tour of how the analysis has evolved is quite informative. We started in 2015 identifying financial risks from climate change, and then we looked at how we should be embedding that in the firms that we regulate, because we noticed there was a gap in those firms, and then we quickly pushed through to doing a scenario analysis, a CBES that reported in 2022, and then we started to look at some of the bigger conceptual challenges, such as those relating to regulatory capital, which I'll come back to in a second. I'm not going to go through each one of those because I don't think we need to. But I think there's a really important message here about, and that leads to a gap, and that is, we have done a lot of heavy lifting, a lot of conceptual heavy lifting, a lot of analysis since 2015 to identify, understand, shine a light on the financial risks from climate change. But we're now entering into a really, really important additional phase, and that is where we have to embed everything that we've learned. And that is the period where we have to put our sleeves up and do a lot of really, really hard work, both in embedding in how we supervise firms, within firms, how they embed those expectations of what we've set out, and also thinking through our policy frameworks, the nitty gritty of how we calibrate our policy frameworks, as well as some of the bigger questions. Now, I appreciate that all of that might seem a little bit intangible. So what I was going to do was talk through how some of the gaps in our scenario frameworks might inform some of this work. But then I saw the presentations from the other presenters, and I felt like maybe scenario analysis had been covered. So what I thought I'd do is just give a brief tour of some of the gaps that we see in the regulatory capital framework, and then talk about how that is insightful in terms of the work that we are doing. And whilst I appreciate the regulatory capital framework might sound a bit dry to some, actually, I think it is probably the most important metric that we have as microprudential supervisors, because essentially what it does is it says, this is the resilience that you need in a firm after looking at all of the risks that you have, both crystallizing in the short term and you expect to crystallize in maybe the medium term, which goes to one of the first presentations that we saw. So if we could just turn to the next slide. What I've set out here is 4 of the identified gaps that we found when we looked at the regulatory capital framework in 2022-23 in relation to the financial risks from climate change. Now, let me just go through each one of those, because what these represent are the gaps to an end state position where we have an understanding of the financial risks as a regulator, but also they're embedded within firms. So the first gap is that we've observed, in order to have a good understanding of regulatory capital, financial firms have to have sufficiently embedded an understanding of the financial risks that arise from climate change. We set out some supervisory expectations of how they should be doing that in 2019. So that's 5 years ago, almost. And there has been progress in firms, but there is a long way to go. And there's been a number of speeches from the Bank of England and also Frank Elderson at the ECB talking about how firms are probably not moving quick enough to do this embedding work. And by embedding, what this really means, it means that you have an understanding of climate risks in the same way that you have of all other risks. Every time you look at your risk appetite, you're pricing in those climate risks, and accordingly, you're pricing in those risks when you're doing your costings across all of your activities. So that is not happening yet to the degree that we would want to see. And there is an important gap there as we as supervisors need to embed an understanding of those risks in our processes, and firms need to embed those risks into what they do on the ground. The second gap is, I think, a really important one, and that is we do not yet have a really good understanding of how climate risks actually manifest within firms. We've done exercises, we've done scenario exercises, and we're getting a better understanding of how they might manifest. But things such as tipping points, amplifications, are in many ways areas that, because there's no precedent, we don't know what they might look like in real life. So there's a real premium on us doing more work to understand how those might arise. But I think this also speaks to a really fundamental point that we're grappling with at the moment. As regulators, as central banks, and as the market, one of the things that we're seeking to understand is how proximate might material risks from climate change be. We see analysis that suggests that physical risks might build over time, and some of them will be lumpy and could arise in the very short term. We see government policies coming through on transition, And some of those are brought in over a very long time. Some of them are brought forward, and the market's transitioning in its own ways as well. So a really key point for us to understand is, could material risks from financial risks from climate change arise in the short term? And does that mean that we need to accelerate the speed of what we're doing even quicker? And I think that speaks to the real value that the short-term scenarios that two of the previous speakers talked about, in terms of the stress tests in the short term, to actually understand that. Because in the absence of doing that analysis, I think there's a broad perception that maybe these risks are going to happen, crystallize in 5, 10, 15, 20 years time. And I think there's a huge value in us looking at that, testing that. And this goes to my third gap, actually, thinking about the toolkit that we should be using to understand those risks. There is a gap at the moment in the toolkits for understanding risks. Typically, microprudential tools are backward-looking or point in time. They don't think about how unprecedented risks could manifest. And it's for that reason that scenario analysis is such an important tool to allow us to look at how different scenarios might arise. But I think it's fair to say that whilst we've come a huge distance on scenario analysis, again, there are gaps in the scenarios that we use, although it is imperative that we have the scenarios and constantly build on them. And also, we haven't yet been able to do really comprehensive scenario exercises on some areas of the financial system, such as the trading books, the investment banks of institutions. So there is some work there to do to fill those gaps, to get a really comprehensive understanding of how risks might materialize across all of the balance sheets that we're looking at. And then I think just a final point is one that was also touched on earlier about how do you think about the horizon over which risks will crystallize and the horizon over which you should be seeking to get prudential resilience. In some examples, to bring this alive, you might get a risk that's going to crystallize in 3, 4, 5 years' time. That is within the existing microprudential horizon. So I think you could have a strong argument for saying, yeah, you should be holding regulatory capital against those risks. But what if what if you know that an item, an asset, an industry is going to be obsolete in 25 years' time? At what point is it appropriate to start to hold capital against that building risk? And I think that's a really important example of some of the big questions that we have to answer in terms of filling gaps in our policy framework. We have a capital framework, it's been tested, it works for the vast majority of risks, but where are the gaps? So there's a lot of work going on at the moment to understand what those gaps look like and to seek to address them. So I'll stop there, but hopefully that just gives a bit of an indication about some of the big issues that we're grappling with as we go into this embedding phase and some of the challenges, frankly, that we've got. This isn't going to be something that we're going to be able to do very, very quickly, but it is something that we need to continue to do with acceleration and focus, because frankly, it is exceptionally important if we're going to understand the financial risks in firms and the broader system. I'll stop there. Thank you.
Thank you, Chris, for letting us have a small peek into the kitchen, if I may say so. Now, let me start with the first round of questions to the panelists. I would like to start with Lucia, and I would like to start with a question from the chat, which is sort of a pedagogic, question. Could you explain again the link between scenario analysis and climate stress tests? Or anybody else might come in. And then I would like to follow up on this. You mentioned that off-the-shelf stress testing models are not suitable to model climate-related shocks. So how shall we do that then? You also recommended the use of granular data, as many others here in this room today. However, these granular data sometimes are not available, or often are not available. So what do you then propose? Thank you.
Shall I?
Yes, please do.
All right, Ernest. In fact, you're right. I mean, I said what one should not do. So then what do I propose? Let me start from the data issue. Now, we would really need to have very granular firm level data on the type of business of each and every company and each and every SME. Now, as of this last year, actually 2023, we have data on the taxonomy alignment of larger companies. But if you know the EU taxonomy for sustainable activities, this doesn't say much on how polluting or emitting these companies are. So these obligations will only kick in the next years. And on SMEs, unless they are listed for the foreseeable future, there are no obligation whatsoever to disclose on the sustainability of their business. So yes, the reality is we are far from having the type of data we would need to do proper climate stress testing. So what I propose is that one could use a methodology that Stefano Battistone and myself developed, which has been used already actually by several banks, by data providers like S&P, and by many policy institutions in their analysis, because of course no one can wait for years before doing some analysis. And this methodology is known as the TAC-TEC methodology, that stands for Taxonomy Alignment Coefficients, TAC, and Transition Risk Exposure Coefficients, TEC. So what we do essentially is to develop a set of coefficients at the level of economic sectors. So we use the NACE classification, which is the one that's used in Europe, the statistical classification of economic activities. And for each and every NACE sector, we provide a coefficient of taxonomy alignment, of greenness, and a coefficient of transition risk exposure, brownness, if you want, for the sector. And these coefficients are all of the TAC are based on the definitions in the EU taxonomy, and many of the transition risk exposure coefficients are based on the definitions in the EU taxonomy. Why many of them and not all of them? Because by definition, the taxonomy covers all green activities. It does not cover all harmful activities. So what we propose is that whenever the only information that the investor or the bank has on the counterpart is the economic sector where the counterpart is active, but they know nothing about the actual level of sustainability of the business of the firm, they could use these coefficients, which reflect somehow the average level of greenness and brownness in that particular economic sector. Of course, these coefficients are not super precise, but they provide kind of benchmark values. They give an idea whereabout the firm could find itself. And for sure, when the aim is to calculate the level of taxonomy alignment of a financial portfolio, or the share of the portfolio that's exposed to transition risk, using these coefficients is by far better than just putting zeros or only focusing on that small fraction of the portfolio on which you actually have information. For banks, this means that the whole SME lending would be cut out from the analysis because, as I said, there are no data on SMEs. So, as I said, it's really important to avoid stigmatizing entire sectors of the economy by using a binary approach. So, some sectors are good, some sectors are bad. By using these coefficients, one introduces shades of green and shades of brown, which is better. Now, let me move to the other point that has to do with the relation between scenario analysis, climate stress testing, and the nature of the shocks, if you want. Now, I said that one should really not assume that climate-related stress for the financial sector could come from a negative shock to the real economy. So the question is, where should it come from? Well, my answer is from the financial sector itself. Imagine kind of a Minsky moment with investors' taste becoming suddenly greener, or to echo the words of Irene, if their expectations would suddenly change because, for example, the green transition becomes more credible. So this could trigger a reassessment of investors' expectations and a reassessment of the expected value of high carbon assets. And this could in turn trigger uncontrolled market dynamics. All of this could happen even tomorrow in the complete absence of any change in the economic structure. And I think this is really key. Now, we have a working paper co-authored with some colleagues at the JRC, which is also available as a VoxEU column, and hopefully will be published soon on a journal. And in this paper, we model precisely a fire sale of high carbon assets. And we investigate what would be the consequences for the EU banking sector. Now, to just give you a very quick overview of the results, we show that under some conditions, even a very small depreciation of high carbon assets, and I'm talking of less than 1%, could trigger the default of some European banks that are particularly exposed. Now, this is only one or two banks in each Monte Carlo iteration, but overall, if you look at the whole banking sector, it's about 20 to 25% of the banks that are on the brink, at risk. And if these bank defaults would trigger panic in the market, then there could be further sell-offs of high carbon assets, which could trigger further depreciations and further defaults of banks. So this could lead to a negative spiral. And so, I mean, you see, we are not thinking of anything that we didn't experience already with the global financial crisis. Some assets turn out to be sour, so there is, dynamics become uncontrolled. And if you add on top of this contagion, second round effect, feedback loops with the real economy, a credit crunch, well, this, I believe, would create enough stress to the financial system.
Thank you very much. Meanwhile, I have another question for you from the chat. So let's just add this on. Do you foresee that the data expected from ESRS will contribute to further research?
Definitely. Yes, definitely. Now, of course, the CSRD has it will be phased in again very gradually. So as researchers, we will need to wait some years. And as I said, listed SMEs will be in scope, but again, not micro SMEs and also not listed. So again, we will always need to face the issue of millions of firms being, out of scope. But the CSRD and the SRS will definitely bring a lot of useful information for further research.
Thank you very much. Let me now turn to Livio. I think many citizens in Europe nowadays get somehow the impression that we in Europe overdo it with climate protection, while the rest of the world doesn't give, So do we put ourselves at a disadvantage here without then being able to reap the benefits because other parts of the world don't, comply with, their commitments and don't go along?
Yeah. So no, thanks for the question. So I think this was mentioned before by Benoit that we should not always not forget that so the EU is a relatively small share of all emissions. So when we describe these scenarios where we contrast the transition and physical risk, we should always keep in mind that our contribution to physical risk is rather small. And in my view, we should not also deny that. So in my personal opinion, but here is a personal opinion because my institution is not a climate policymaker, of course, is more a follower than a policymaker. But in my personal impression, the green transition is worthwhile even without that component. Why? Because first, keep in mind, so we are importers of energy, and as you have seen, we import energy from sometimes unstable or authoritarian countries. and sometimes we suffer from that. So there is a question of energy security. There is a question of autonomy. And there's also the question that it is good, once in a while to be ahead of the curve as well, because I mean, in Europe we are not ahead on many things, but it is one of the area where we can really be ahead and read the benefits later. So if we become leader in the clean technology, in the clean energy, in turning society, in a cleaner path, then of course, this is something that eventually will come to the rest of the world, maybe later. So being ahead and being the first is also, I think, is a good place to be. So maybe we should reorient the discussion in that direction. So that is something that is good to do. It's good to be ahead. It gives us energy independence. We gain because we can produce renewables, but we cannot produce much fossil fuels. And we don't do it because we curb emissions on our own, because we have to be honest, we are not that big to influence the climate change alone. So that's so we should be really open and honest about it. Thank you.
I really sympathize with your questions, but I cannot help, challenging them. I don't let you off the hook so easily. So, again, if you read in the news, one slogan might be, we now shift from strategic energy dependence to strategic dependence on critical minerals. So what would you say on that? And then on your second argument, there can be a first mover advantage, but there can also be a first mover disadvantage, as the history of technological progress sometimes has shown. I mean, there are also examples of first mover advantages.
Yeah. Okay, so starting from the second, yeah, it is well possible, but as I said before, maybe it's time that the EU leads on something. So, we are second mover on almost everything. So perhaps we should try the feeling to be the first mover on something. And on the first point, you said about energy independence. So can you repeat the question? Critical mineral. Yeah. So here, actually, the scientists in the room should answer, because I really don't know how substitutable this is. So it's a technological question. So what I know is that scarcity of minerals has never been, I think, in history, an absolute scarcity. There is always I think somebody said that the scarcity always creates its own glut later. So I cannot believe that these minerals can be substituted. And I guess it's a technological question. So I don't think we will be a hostage to these few producers of minerals. But here, maybe I'm relieving my ignorance on the technology. So maybe somebody can help here. Yeah.
Benoit, I hand over to you now.
No, just on this point before you hand over to me. No, I think the issue is it's not the dependence on minerals itself. The issue is the dependence on the transformation of minerals into materials that we need for the energy transition with the current technology. So technology can change. But over 90% of the transformation of those minerals into materials that we can use to produce solar panels and electricity infrastructure and so on and so forth. It's China. It's all done in China, but China has become the manufacturer of the world. And in the transformation of those minerals currently, it's 90% of world capacity. So there is very much with the current technology, and I mean, China did develop this over 2 decades, so maybe others can as well. But at the current juncture, that's where there's a big dependence indeed.
Now, I have another question for you. In the discussion, you mentioned this, for instance, what is the risk for investors actually? So if you look at market outlooks for 2024, as you mentioned, actually investors don't see much climate risk. There are other topics which move them. So where is exactly the risk for investors, and how can they hedge against carbon risk, and what is the relevant time horizon in your view?
So thank you, Ernest. That's a very important question, and also a difficult one. So my sense is, and it goes in the direction of what Lucia was saying in her answers, is that transition risk may be bigger at a shorter horizon. And one current dynamics where actually the EU is leading is in disclosure. So the ISSB norm has been or a EU version of the ISSB norm in terms of disclosures are becoming mandatory in the EU. And in Asia, across Asia, in part because for large parts of Asia, being in the tropic, the temperature rises represent a bigger risk sooner than for our part of the world, possibly for this reason, possibly for other reasons. They will move to the adoption of ISSB norms in terms of disclosure. And with the EU and Asia moving in this direction, Asia/China moving in this direction, you already have a large part of the world. So when this becomes available, it means that for most financial asset issuers, there will be this ISSB disclosure, which tells basically how much carbon you emit, what's your governance vis-à-vis carbon risk, and how you will manage this carbon risk. Which means that between two firms which will be nearly identical, investors can always go to the firm with a lower carbon and a better carbon policy. So the type of fire cells that you were describing, I think that's where it becomes. I mean, the intuition is there. It's relatively easy to imagine that once we have more transparent disclosure of carbon emission across issuers of financial assets, stocks, bonds, loans, that it would be much easier to go towards the best in class. And this may trigger actually large increases in the return on capital, not the return, sorry, the cost of capital for the firms that will not be doing as well as a best in class. So I see this maybe the horizon of such fire cell externality. I think it's relevant at the horizon of 5 years. But when it goes to risk, and that's also reacting to some of the presentations that were made earlier, the political risk is a very big one. We see the timing at which we are putting in place implicit carbon tax, like the Biden's policy, the Inflation Reduction Act, is setting a target for the US to get to, I think, 50% electric vehicles by 2030 or 2035. But this was not expected. So you have these sudden instances where economic policy is shifting the needle of implicit or explicit carbon taxes. And it can go in the other direction. The obvious case is the election of Trump. But even currently in Canada, they are kind of having second thoughts on the carbon tax. And so that's the essence of risk. It can be in both directions. So I think the long-term direction of travel, we see a lot of shift. The production of electric cars by China is going to explode. Okay, so we are moving towards this type of technologies. Steel makers in Asia, in China, actually are thinking of ways that they can still export steel to the EU because there will be the border compensation mechanism. So, I mean, we see those changes, but it's the pace of those changes is so hard to predict that we have financial risk. And I think Lucia really has a point that among the financial risk out there, which is an echo actually of the tragedy of the horizon that Mark Carney laid out already in his speech in 2015, would be that some assets become stranded much faster than you had expected. And we know is that, with Elena here, I'm sure that you've been teaching a lot Diamond Deep Vig. That's the type of mechanics that we may see. This transition risk may come in relatively quickly at some point, and I would say in the medium term.
Thank you very much. Yes, please, you have a question. Stefano. Gentleman here. No, that's fine. Yeah, please go ahead.
Hello, I'm Lorenzo Manganelli, dual master student in policy analysis at Bocconi LLC. Thank you very much, first of all, for organizing. And my question is to Mr. Straka and Mr. Marjan. If you could elaborate a bit more on focusing on, like, my question is more, why can't we have maybe like a Brussels effect on sustainability and influence on that a bit more, so be a bit more strategically on like the client side, and maybe what Mr. Marjan, you were mentioning in your presentation about influencing like India and having more sustainable. We achieve that and convince developing countries to rely more on sustainable sources than cheaper brown sources. Thank you.
And Stefano, please. And Donato.
Stefano Battistone, University of Venice and Zurich. So thank you very much. This panel was very, very interesting. I agree very much with the comment on why should we do engaging the transition, the European Union, even if we are alone. There, of course, you can never be sure that there aren't any first mover disadvantage, but there's certainly some first mover advantages. I wanted to have your view on the following. Lucia has proposed a way to reconcile a bit the long term and the short term, and I very much agree with that. And this is precisely also the narrative that, together with Irene Monasterolo, we've been proposing for stress testing already some years ago, and it is the following. So even if the main differences in demand faced by different sectors, therefore by firms, start becoming very important maybe in 10 years from now, when you do the computation, you carry out the financial valuation of a firm, say oil and gas firm, and you front load that difference, now that difference becomes substantial now. So the question is, how do you interpret that? So you do the financial valuation of business as usual, financial valuation in say net zero. An oil company faces a difference in value today, the difference in net present value today in one scenario compared to the other scenario of about 50 to 80%, depending a bit on scenarios and the type of technology. So if investors are changing their expectation today about, or say during the night, about which scenario materialize, that's the value of the loss. Now we can discuss, maybe this is happening a bit spread out in time, because not all investors will change their expectation exactly at the same point in time. So that resolves, in fact, if we take that view, this resolves all the concern about, but climate statistics are about 3 to 5 years horizon, while the big changes are far away in time. As long as your valuation, as long as the your valuation exercise comprises those time in which the trajectory becomes different, the difference will appear at the moment in which the expectations are changing. So I wanted to get your view on, is there anything, do you have any objection on this narrative? Do you see it as appropriate for, in particular, the climate stress tests or not?
Telegraphic question, I hope, across the pan as the usual, the previous one. Let me borrow from Benoit. Benoit said there is a trajectory, a long run trajectory, friction and lags. So it seems to me the story of the relationship between long run and business cycle. The first derivative is clear. Perhaps we can discuss on time lag and second derivative. Are you sure of this? In the sense that I remain to be convinced, because the political decisions are in the hands of politicians, and politicians are career concern players. They are myopic players by definition. Just to give you an example, I read the 2025 project of the Republican Party, page 740, on the Fed. Elected officials must clamp down on the Fed's incorporation on any environmental, social, and governance factors into its action and mandates. These are the politicians. So, but it's not a rhetoric question. Are you convinced that there is a trajectory that is clear, the first derivative, or not? And really, just to be ignorant, knowing the politicians, I remain to be convinced.
Okay, so let's start with Benoit, then go to Livio, and then I also have a question for Chris.
Yes, so thank you for the question. So let me try to cover the three questions. So electric vehicles sales in the EU in 2023 were 38% higher than the year before, and I very much agree that politicians have a very hard time to have this long horizon. And I also see in G20 meetings that getting to a global consensus is, you know, it would be a form of miracle. So actually, I heard once Livio saying that, you know, he think the most likely is going to be some form of diverging. So some part of the world will go in one direction and the other part of the world will decarbonize. And I think that, in my view, that's also the most likely, if I can borrow from you, Livio, here. This being said, the private sector, he thinks that part of the world is going to decarbonize and they are preparing. And we hear more and more frequently that an increasing number of private sector initiatives are going in this direction. Going back to the different horizons, and maybe this can liaise with your question. If you ask long-term investors, the one who invest at very long horizons, so they tell you, you can't fund new investment in oil. And investment capex in oil has been divided by 2 between 2014 and today. It's very difficult because investors are thinking of this long-term risk, and they are thinking, well, 20 years from now, what will be the demand for oil? Will it be large enough that you know, my oil, which is going to be way more expensive to extract than the one that you extract from Saudi Arabia for $2 per barrel, you know, would there be a market for me? So the world is already changing. I mean, the train has left the station. Whether we already at the tipping point where this become very wide adoption or not, I don't know. And I think there's a risk in the timing, but the direction, yes, I'm relatively optimistic. You know, 1.5, probably not. 2.1, maybe. Okay. So we may get to 2.1, and then, you know, you have population declining and so on and so forth. But going back to thinking of long-term and short-term valuation and whether this is already factored in, you know, I think what I just mentioned as anecdotal evidence, but also hard numbers, that investment in fossil fuel have been divided by 2 the last 8 years. Okay. I think that's where this is taking place. Those investments in those companies are not taking place. So they are changing. Some of the large oil companies are already going towards multiple energy and trying to diversify the energy that they supply. So I think that's the way this long-term risk is influencing what they are. And it's also very likely that within 10 years, technology will change. And so I think that's how we will see that this transformation may be taking place and the pace at which we would see it. I think that, you know, expecting from investors that they can do the integral of all the scenarios with weighted probabilities, and that this would influence the evaluation today, that's maybe demanding a lot. Yes, but you know, that's a fairly complex valuation exercise that we are asking them. Yes, and so it takes the form of already a lot of capex going away from some oil, some fossil fuel development.
Livio.
Yeah. Couple of quick points. So on Lorenzo's question on the Brussels, I mean, if I understood correctly, the Brussels effect, you mentioned the Brussels effect. Yeah. So this, I guess, is an additional argument for first moving. So you know, given that not only we are one of the world's major economies, you know, a bit less now with the UK, without the UK, but still among the major. Plus, we are also the most open one. So we trade more than US and more than China. So this already gives, you know, the standard setters in Brussels some advantage in influencing others. So it's possible that it's well possible that actually what we do here in terms of standard and so on is, you know, influence other countries. And then there is a snowballing effect. So I believe that maybe this is not a major, the main consideration, but is an additional element for, you know, towards, you know, moving fast and first on the green transition. If I understood your question correct. So on Stefano's question, so I guess, yeah, so these short-term scenarios that we might, you know, target a bit that type of shift. So it's a bit the animal spirits question. So as Benoit was saying, you know, the investors have difficulty making the integral of scenarios and so on. So I guess this is precisely how investors operate. So they jump quickly from one scenario to the other, you know, due to animal spirits, and that's why the effects can be large, because of course, you know, these scenarios have different kind of pricing implications. So this is exactly what we remind short expectations for some kind of sunspot reason. So how relevant it is, I don't know, but that's precisely, you know, the purpose of this exercise. And also one just going to comment on Donato's question on the politicians. I mean, I guess this is precisely the reason also why this project is very much at the EU level and is driven by the Commission. I don't think maybe I'm not sure about Macron. Maybe Macron is behind, but I don't think the EU leader, the main EU leaders are behind the green transition very much. I mean, they accept it certainly, but I don't think they push it. You know, they comes from the Commission, no? But tell me if I'm wrong. I mean, I'm not a political analyst.
Yes, it was a question on incentives for production of electricity or bronze sectors in emerging countries, emerging economies. So for those economies who are interested in attracting capital from the rest of the world, the trend toward ESG investment, I think there would be a relatively low-hanging fruit to redirect capital within those countries from, say, coal production of electricity to windmills and solar panels, and that showing that a financial institution, say a large bank in a large EME countries, is committed to be on this net zero trajectory for its portfolio of loans would allow actually this large financial institution to issue bonds that can be labeled as net zero bonds, or and that's basically a way to attract capital and get cheaper funding for this financial institution in a large emerging market, for instance.
Thank you. I want to conclude the panel with a question to Chris. Now, I think in today's meeting, the issue of short-term focus was raised a couple of times. Procrastination comes to mind. So my question to you would be, you talked about the need to get a better understanding of the proximity of risks. What does this mean in practice? What are the insights of the Bank of England, and how can a better understanding of the proximity of risk help us in getting climate change and the energy transition on a firm path?
Great, happy to speak to that. And if I can just very quickly raise 2 points on the excellent discussions so far. I think on the precious metals thing point, it's so interesting because one of the things that researchers have looked at is the flow of precious metals and what it means for the availability of green energy. And one of the really fascinating things that you can see coming through in firm scenarios, in a lot of scenarios done at a system-wide level, is that they assume that you're going to have a greater influx of green energy than the current flow of precious metals might allow for. So I think that this speaks to the value of having a central view of scenarios that are coherent and provide views on what the capacity is in the market at any one time. And I think two things that we haven't mentioned so far today is transition plans, which is a tool for us to reach into the real economy to understand what firms' plans are over the future, so we can test assumptions that they're making on things such as the opportunities that they're going to have, to what extent they think they're going to be moving into certain sectors and away from other sectors. And the other factor, which is really, really important, is we talk about climate, but often, but we also need to bear in mind the nature impacts of the actions that we're taking for climate. So the more precious metals that you dig up in order to create more green energy capacity, that does actually have a nature biodiversity impact. So what's the risks of that? How do we price that in? So I just flagged that because I think it's increasingly important as an area of focus for those of us that are looking at the risks that could arise from these activities. And just finally, on your question on proximity of risks, the reason I raise this is that there's a lot of conceptual work that could explain why climate risks could give rise to significant financial risks in the very short term. And that would suggest that we should be working exceptionally quickly to build resilience against those risks. We should be adapting our economies to ensure that those risks are not as high as they might have been. And we should be doing that now. But to the point that you were just making before on the politics, I think there's also a strand of thought that says these risks, perhaps particularly in Europe, will not crystallize in the very short term. So therefore, we have some time to take action, and it's not quite as urgent as others would make us believe. And that means that policy tools such as the development of disclosures might be delayed. Policy clarity over how the economy might change over time might be delayed. There's all those temptations. So one of the things that we want to test ourselves on is, doing analysis, using scenarios to say, well, what is the likelihood of having a very material near-term risk, and how worried should we be? In doing that, we hope to be able to calibrate to a greater extent how quickly the work we should be doing, how quickly we should be doing this work. But we are, of course, also open to the fact that maybe these risks won't happen in the very short term when we do analysis. I suspect that isn't the case, but when we do analysis, maybe, especially in some of the more northern countries that have relatively less physical risks crystallizing, maybe it'll be slightly further out. But there is a bit of a gap in terms of analytical work that really speaks to that point at the moment. And that was what I was talking about. The more foundational evidence that we can have to support the assumptions that we're making, I think the greater the argument could be for having policy to support those arguments. I'll stop there.
Thank you, Chris. So I think this brings this panel to an end. This brings also today's conference to an end. I could now delve into the things that I take along for maybe half an hour or an hour. I just want to briefly summarize by saying I take along there's lots of work going on, lots of very interesting work. Big progress is being made every year, every single year. It's work in progress, but we're on the right track. You mentioned just a few figures, which are very impressive, also on the actual front of decarbonization. So we are on the right track, but there is much more work to be done. And maybe the as in monetary policy, we often say the last mile is the most difficult. No, I mean, here we definitely are not in the last mile, like with inflation fighting. So I think we are still having a substantial part of the road ahead of us. So much more work will be done, will need to be done, and much more convincing will need to be done. I want to express my gratitude to the panelists for bringing in your views so well here, your own views and your institution's work. I want to thank all the speakers in this conference. I want to thank the initiators and the scientific organizers of this conference, Elena, Irene, I think you're still here, Valentina, where is Valentina? Valentina is not here. Okay. I want to thank Donato and Daniel for your generous sponsoring and support through your respective centers. And I want to thank Silvia, Elena, and Dragana for making this actually happen, because without you, this wouldn't be possible. So it's great cooperation. Thanks to all speakers. Thanks to all of you for coming here and for discussing with us and for asking so many interesting questions and for making. Yes, no, I think the weather turned fine as well this morning after yesterday's rainy. Yes, thank you very much and bye-bye.